आप फिर से स्टार्ट करना।
Hello, good morning, students. Hope you have done the homework I have given to you yesterday. Today we will start with Ind AS 10 events occurring after the reporting period. So let me share my screen. Yes, hope my screen is visible to everybody. So Ind AS 10 basically is a small and simple standard, and the objective of this standard is to tell when to adjust financial statements for certain events. And these events are of two types: adjusting events and non-adjusting events. Adjusting events means those events which are to be adjusted into the financial statements. Means financial statements will be given effect for these events before their approval. And non-adjusting events are those events which will not get adjusted into the financial statements, and only disclosure will be made in the financial statements, but no accounting will be done for these events. So these are called non-adjusting. So adjusting means those which are getting adjustment. Non-adjusting means those which are not getting adjustment to the financial statements. Now, let me take an example first. If I am preparing the financial statements for March 20, then March 20 is my end of the reporting period. That is, the reporting period is 1st April 2019 to 31st March 2020. So this is my reporting period. End date of this reporting period is 31st March 2020. Now, if any event which has occurred after 31st March 2020, that is after the end of the reporting period, but before the approval of these financial statements by the authorized person, that is, for example, in case of company, board of directors approves the financial statements in the board meeting. So if after 31st March, and say for example board meeting is scheduled on say 15th of May 2020, then between this period 31st March to 15th of May 2020, this 1.5 month is the period after the end of the reporting period and before the approval of the financial statements by the board. So this period, if any event occurs in this period, then we need to check whether that event needs to be adjusted or not basis on the conditions prescribed in the standard. And if that event needs to be adjusted, then I will take effect of this event in my financial statements and financial statement, and I will also make the disclosures. But for non-adjusting events, I will not take effect into the financial statements, and I only will make the disclosures. So that is very clear. Adjusting are those which are getting adjustment. Non-adjusting are those which are not getting adjustment. Now we need to understand what is the difference between these two events, or what is the nature of these two events, so that we will be able to decide which events are adjusting events and which events are non-adjusting events. But before that, let me tell you what is the full objective of this standard. The full objective of this standard is to prescribe when to adjust financial statements for events after reporting period. So it tells you which events are those events which will be adjusted in the financial statements, and which events are those events which will not be adjusted into the financial statements. Then after it tells about these events, then it also prescribes some disclosures which we need to make for both adjusting events as well as for the non-adjusting events. And it also tells that we need to disclose the approval date of financial statements for issue. So approval date of the financial statements is, in case of company, the date on which the board of director approves the financial statements. So that date is called the approval date for the financial statements in case of a company. Now, if board approves on 15th of May, then 15th of May becomes the approval date that we need to mention in the disclosures or notes to accounts of the financial statements. Now, again, third item which the standard talks about is going concern. I hope everybody knows what going concern is. Going concern means that from the end of the reporting date, means 31st March 2020, management doesn't have any doubt on the continuity of the company business for next 12 months or for next one operating cycle. So that is called the going concern assumptions. That is, we prepare our financial statements basis on the going concern assumption that our business or our company will continue to run for at least next 12 months from the reporting date. That is from 31st March 2020 till 31st March 2021 at least. So that is a bare minimum. This is called the fundamental assumption basis on which we prepare our financial statements. But this standard is saying if management has a contrary view, that is, management doesn't believe or doesn't think that they will be able to continue the business for next 12 months from the end of the reporting period, then going concern assumption is not complied, or the going concern assumption got a hit. Hence, we need to prepare our financial statements on liquidation basis. We cannot say that we are a going concern company. Hence, we will not be preparing our financial statements on the basis of going concern assumption. So that is the standard talking about all about the going concern. Now, let me revise. So standard talks about adjusting events. Standard talks about non-adjusting events. Standard talks about disclosures about these adjusting events and non-adjusting events, and standard talks about when going concern assumption is not appropriate, then do not prepare the financial statements basis on the going concern assumption. So standard is not saying when going concern, when there is a going concern and when there is no going concern. A standard is saying when management believes that going concern assumption is not appropriate, then please do not prepare your financial statements assuming or basis on the going concern assumptions. So that is the ask from the standard. I hope the objective is very clear. Now, what is the scope of the standard? This standard shall be applied in accounting for those events which are occurring after the reporting period. After the reporting period means after the end of the reporting period. After the end of reporting period means 31st, if I am preparing the financial statements for March 20, then 31st March 2020 is the end date of the reporting period. And if any event occurs after this date, but prior to the approval of the financial statements by the authorized person, that is board of directors in case of company, then these events are to be classified into two categories, adjusting and non-adjusting. So that is both the events are covered in the scope of the standard. And what are the disclosures which we need to make about these adjusting and non-adjusting events in our financial statements. So that is the scope of the standard. Now, events after reporting period is defined by the standard. So although we have understood what does it mean, but let us read the definition which is provided by the standard itself. Events after the reporting period are those events favorable or unfavorable to the company. So it may be favorable events or beneficial events for the company, or it may be unfavorable events or non-beneficial events for the company. Doesn't matter. That occur between the reporting period, that is 31st March 2020, that is between end of the reporting period and the date when the financial statements are approved by the authorized person, that is board of directors in case of a company. So in our example, events occurring between 31st March 2020 and 15th of May 2020. So this 1.5 month period, if any event occurs in this 1.5 month period, then those events are called events after reporting period. Okay, so this is the definition of the events after reporting period. Now, as I mentioned that there are two types of events, adjusting events and non-adjusting events. Adjusting events, those that provide evidence of conditions that exited at the date of the reporting period. Now, first of all, we have understood there are events, and events after reporting period we have just understood, that is events occurring between the end of the reporting period and approval of the accounts. Now, these events are classified into two categories, adjusting events and non-adjusting events. Adjusting events are those events that provide evidence of conditions that exited at the date of the reporting period. That is on 31st March 2020. That is the date and date of the reporting period. On that date itself, there were evidences available that these events are occurring or these events are about to occur. Okay, so there were some evidences available that management was aware that these events will occur. So this is called adjusting events. And non-adjusting events are those that are indicative of conditions that arose after the reporting period. So let me take an example. Suppose at the end of the year, I have a debtor, Mr. A, and for rupees say 1 lakh. So in my books of accounts, there is a debtor, Mr. A, for rupees 1 lakh as at 31st March, which is coming in my debtors. Now, at 31st March 2020 itself, management of the company was aware that the credit worthiness or financial condition of this debtor is not good and it may become insolvent in some time. Okay, so there were evidences available because this debtor was not paying, was not able to pay its liabilities to any of the lenders, and this kind of information was available as at 31st March, and management was aware of this information. Then this information was available, evidences were available that this debtor is about to become insolvent. Now, on 10th of April or on 20th of April, this debtor has filed for insolvency proceedings. Now, this is the event. Filing of the insolvency proceedings is an event which has occurred after the end of the reporting period, that is after the 31st March, and before the approval of the accounts, that is 15th of May in our example. So if the debtor has filed on 20th of April for its insolvency proceedings, then this event has occurred between this time frame. So this is the event for me, event occurring after the reporting period. Now, I just need to see whether this event is adjusting event or whether this event is non-adjusting event. Now, what the definition of adjusting events tells? Those that provide evidences of conditions that exited at the end of the reporting period. It means conditions were there, management was aware that this debtor is about to get insolvent, although event has not occurred by that time. He has actually not filed for insolvency proceedings, but on 20th of April he has filed. So it means event has occurred. Now I was very well aware about this event about to occur. So this is called adjusting event. It means I need to take effect of this event in my books of accounts. What is the effect in my books of accounts? I need to simply provide for the debtor up to the level I believe, basis on information available today till the approval of the accounts, that how much amount I will not receive from this debtor. So say if management estimates that out of the 1 lakh, 80,000 will not be received, then I will provide for 80,000 provision and only 20,000 will actually be reflected in my debtor balance. So this adjustment I need to make in my financial statements. I hope adjusting event is clear. Now let me take an example of non-adjusting event. Non-adjusting event. So my balance sheet was available for 31st March 2020, which I was preparing. There were certain inventories in my balance sheet. say again for rupees 1 lakh. Now, on 1st of April or on 2nd of April, that is after the end of the reporting period, heavy rains have occurred in my godown or in the area where my godown was situated, and lot of inventory items, got badly conditioned because of this rain. Now, this is the event which has occurred after the end of the reporting period. Yes or no? Yes. This is the event which has occurred prior to the approval of the accounts by the board of directors. Yes or no? Yes. So this is the event qualifying for the definition of events after reporting period. Yes, events after reporting period. Now I just need to see whether I was aware that this rain is about to happen and this rain will impact my godown. No. And even if I was aware about the weather forecasting, I cannot say that this event is going to happen 100%. So in this case, I will say there were no conditions or no evidences available as at the end of the reporting period that this damage to inventory will happen. Hence, these events are in the nature of non-adjusting events, because those are indicative of conditions that arose after the reporting period. Indication was there that rain may happen because of weather forecasting, but there were no evidences available that if the rain happen, it will damage my inventory in my godown. Okay, so this is the event which are only indicative prior to the end of the reporting period, but were not able to provide any sort of evidences or conditions. Hence, these events are called non-adjusting events. I will not take into account the impact of damage on my inventory. So if my inventory was being reported at rupees 1 lakh in my financial statements, although it has been damaged significantly by the rains which has occurred in the month of April, that is before the approval of the financial statements on 15th May, then I will not take a inventory provision on my inventory of rupees 1 lakh. I will continue to report inventory at rupees 1 lakh only. I hope adjusting event and non-adjusting event is clear, but we will discuss more examples or almost 5 to 6 examples so that we get to know what are the events which are adjusting events, what are the events which are non-adjusting events. So examples of adjusting events: settlement of a court case after the reporting period that confirms that the entity had a present obligation at the end of the reporting period. Now, examples of adjusting events. Adjusting events means those events which will be adjusted into the financial statements because these events have provided evidences and conditions exiting at the date of the reporting period that these events are about to occur or may occur. Now, settlement of a court case. So court case was already running for say 2 years, 3 years, 5 years, and it has to settle someday. So management knows that settlement will come in some time. So as at 31st March 2020, I was very well aware what is the nature of the court case, what are the implications of this court case. If I lose the case, what are the implications? If I win the case, what are the implications? So management was aware about all these things. So there were evidences available, there were conditions exited at 31st March, and after 31st March and before the approval of the financial statements by the board, that is before the approval of financial statements by the board, that is on 15th of May, court has decided this case. Then this event has occurred because decision of the court case has now arrived. So arrival of this decision is the event which has occurred within this period, that is after the end of the reporting period and before the approval of the accounts. Okay, so this is an event which has occurring after the reporting period. Now, this is an adjusting event because I was very much aware that this decision has to come. But the only thing is I was not aware about the timing when it comes. So it has come, so I need to take it to account for in my books of accounts, or I need to adjust my books of accounts. So for example, if I have already provided a provision of rupees 1 lakh, say if I lose this case, I will be paying rupees 1 lakh to the other party, so I have provided for rupees 1 lakh in my books of accounts. But when the decision comes, I come to know that I need to pay 2 lakhs and not 1 lakh. Then I need to increase my provision from 1 lakh to 2 lakh because of losing the case for which decision has come subsequently, that is after the end of the reporting period. So this 1 lakh extra provision I will be making in my financial statements, hence I am adjusting my financial statements, hence this event is called adjusting event. I hope this example is clear. Now the next example is bankruptcy of a customer that occurs after the reporting period usually confirms that the customer was credit impaired at the end of the reporting period. So this is the same example which we have just discussed previously, that there was a customer who was not sound with his economic affairs, and his creditworthiness was continuously downgrading, his ratings were downgraded by the rating agencies, or these kind of evidences were available to me, and I was very well aware that this customer has difficulty to pay my amount of rupees 1 lakh. So after the end of the reporting period, he has filed for bankruptcy. So event has occurred, and this event is called adjusting event because evidences and conditions were existing at the end of the reporting period. So this event is again an adjusting event. Third example, sale value of inventories after the reporting period may give evidence that their NRV at the end of the reporting period is because of the NRV. So let me take an example. If I have an inventory of rupees 1 lakh in my books of accounts as at 31st March, and I have recorded that inventory at cost, because as per India's 2, we know that inventory needs to be valued either at cost or at NRV, whichever is lower, and I have valued the inventory at cost. But on 5th of April or on 10th of April, after the end of the reporting period, I have sold these inventories at a price below its NRV or at NRV. Okay, then selling the price below the cost means that inventory was already impaired as of 31st March. Assuming that no rains are happening and no event has occurred, it is simple that without any further event, I am just selling the inventory at NRV or low, at a price lower than the cost at which I have recorded the inventory in my books. So it means there were certain impairment which should have been recorded on this inventory at 31st March. So selling an inventory in the month of April below the price I have recorded the inventory in my books of accounts indicates that inventory was impaired if no subsequent event has occurred like rains. Then this is again an adjusting event, and we need to provide a provision for the impairment of the inventory in our books of accounts. So this is again an adjusting event. Fourth, determination after the reporting period of the cost / proceeds of assets purchased, sold at the end of the reporting period. Now, determination after the reporting period of the cost or proceeds of assets purchased or sold before the end of the reporting period. So if I have sold some assets, or I have purchased some assets within the year, but I am determining the values subsequently, then it means whatever values I determine subsequently, I need to adjust my original values for that. So this is again an adjusting event. For example, sometimes some machineries are purchased, or certain assets or certain items are purchased. So there were certain extra expenses which I have incurred or need to incur to get the inventory or to get the asset at its desired location. Then those expenses bills have not yet arrived. So I am just determining the total cost, and by the end of 31st March, I did not receive these invoices. So I was not able to determine the correct cost which I have actually incurred for the purchase of these items. So in the month of April, when I received the invoices, basis on that, I will be adjusting and I will be taking effect of these items in my financial statements. So this is just a fact, just a thing that determination is happening subsequently. Transaction has taken place already within the financial year. If the case is that item is purchased subsequently, then definitely everybody knows that it is not going to be accounted for. So item has already been purchased. It's just that determination of the cost couldn't have happened or couldn't have been determined by the end of the reporting period. So I determined it subsequently, so adjusted it. Now, discovery of fraud or errors that show that financial statements are incorrect. So, if I am preparing the financial statements for say March 31st March 2020, then subsequently before the approval of the financial statements by the board of directors on 15th May, say somewhere in the month of April, a fraud has been noticed, and the fraud pertains to the period 1st April to 31st March 2020. Now, fraud has happened within the period. It's only come to our knowledge subsequently. So it is an event after reporting period. Yes, it is an event after reporting period, because fraud is coming to our knowledge is an event which has occurred after the end of the reporting period, but before the approval of the financial statements by the board of directors in case of company. Now, this fraud pertains to this period, and I need to adjust my financial statements for the impact of this fraud. So, for example, if the cash had been misappropriated by the cashier in March 20, now when I start preparing the financial statements in the month of April for the March 20, I reconcile the cash with all the payments happened subsequently, all the receipts happened subsequently. Then I realized that there is a difference in the cash balance as at 31st March. Then I investigated it further, why there is a difference, and I come to know that our cashier has misappropriated some cash. Now, this is a fraud which has occurred within the year itself, but has come to my knowledge only after the end of the reporting period. So this is an event which has occurred after the end of the reporting period. Now I need to adjust my financial statements for this event. So if the cash misappropriated is by rupees 1 lakh, then I will be passing an entry P&L debit by rupees 1 lakh for loss against theft of cash. So this is a loss against theft of cash, rupees 1 lakh. I need to adjust my accounts. Hence this event is called adjusting events. I hope adjusting event is now very clear to all of you. Let me see what are the queries. So question is, will they assume going concern assumption in pandemic? Okay. Now, pandemic like COVID-19. COVID-19, everybody knows that hitting the businesses across the globe. So there are certain businesses which have severely impact because of this COVID-19. There are certain businesses which do not have severe impact because of this COVID-19. If because of COVID-19, a particular business has so severe impact that management believes that they will not be able to continue the business for next 12 months, then definitely their going concern assumption has got a hit, and hence they cannot prepare the financial statements for March 20 on a going concern basis. So that is for sure. So pandemic may hit going concern, that is correct. So next question is there any mandatory timeline to have a board meeting? So this question pertains to the Companies Act 2013. not to the Ind AS 10, because Ind AS doesn't prescribe that when the board meeting needs to be scheduled. Companies Act prescribes that every company has to comply with the board meeting, 4 board meetings in a year, and they prescribe certain time limits. Says within 6 months the financial statement should have been approved by the board of directors. So 30th September is the last date by which every company should have board meeting for the approval of the accounts. And in case of listed companies, since SEBI prescribes only 45 days for the approval of the accounts, so every company has to comply with those provisions in case of listed company. So different regulations are there for different companies, but India is silent on this matter. Whether Ind AS 10 is applicable to present corona catastrophe? Yes, I just mentioned. So if because of corona or COVID-19, a company's business has a severe impact that management believes that they will not be able to continue with this business for next 12 months, then definitely it is not appropriate for them to prepare the financial statements for basis on the going concerns. Okay, so yes, corona may impact business severely. That is possible. Sir, it is enough to know that debtor is insolvent before the reporting period, or some valid evidence is necessary to consider it adjusting event. Okay, so valid evidence means what? If the rating agencies like Fitch, CARE, CRISIL have downgraded severely for a company. For example, let me take an example. Suppose if there is a company ABC Limited, and ratings of ABC Limited has been downgraded to D. D means default by the CRISIL or CARE before the 31st March. Okay, but by that time, 31st March, ABC Limited didn't declare them to be, insolvent. So event has not occurred, but there were evidences because ratings were available on their website, ratings were available in the market, and ratings were assigned as D for default. So I was very well aware that ABC Limited is not in a position to pay my dues. Hence, there were evidences. The only thing is declaration of insolvency has come in light post year end. So that is an event which has occurred after the end of the reporting period. So that is called an adjusting event. Sir, what if in case of earthquake after balance sheet date which affects going concern, should we take it as an adjusting or not adjusting? So first of all, let me repeat it again. Events are of two types, adjusting events and non-adjusting events. But if earthquake, rains, or some other natural calamity or some disease like COVID-19 has occurred, and because of this the impact is so severe on my business that management believes or started to believe that they will not be able to continue the business for next 12 months from the end of the reporting period, then their going concern assumption has been hit, and hence they cannot prepare their financial statements on going concern assumptions. They have to, if they prepare, it is not appropriate. Okay, so going concern is not an adjusting event. Going concern is a very big event that I am not able to prepare financial statements on going concern assumptions. My fundamentals assumption is hit. So this is not adjusting. This is impacting the preparation of my financial statement itself. I cannot say that I have taken into account the impact of going concern in my financial statements and these are my financial statements. I cannot prepare financial statements on going concern assumptions. So that is the impact of going concern. If you feel that because of earthquake going concern assumption is hit, then you cannot prepare your financial statements. It is not about adjustment. It is about ability to prepare financial statements on going concern assumptions. I cannot prepare. Okay. So favorable events and unfavorable events. Court case has come in my favor. Subsequently, it is a favorable to the company. Company has made a provision for rupees 1 lakh and suddenly court case has been decided in its favor, they need to now reverse the provision of rupees 1 lakh because they have won the case subsequently. So 1 lakh will be shown as a reversal. So this is a favorable event. Unfavorable court case, loss of court case. So that is unfavorable event. What is the difference between indication and evidence? So indication is when there is no documentary evidence available. It is only an estimation. So estimation. So rating agencies have not downgraded the ratings of the customer. Okay. Customer was sound enough to pay all his dues because there was no news about the creditworthiness being downgraded of the customer. Okay. But after April, suddenly customer's business got so severely impacted that now he is not in a position to pay. Then this will be non-adjusting event because as at 31st March, customers were sound. There were no evidences available. And there were only indications that Corona has come. But because of Corona, if customer's business got severely impacted and now he is not able to pay, then this is a non-adjusting event because event has occurred subsequently. Customer was not credit impaired by 31st March. So if the customer was credit impaired by 31st March but filed for insolvency later, then adjusting. If the customer was not credit impaired by 31st March and become credit impaired after 31st March and filed for insolvency, so both the things are happening after the end of the reporting period, then it is a non-adjusting event. What is impairment loss? So impairment loss is nothing. So when my asset loses its value or the amount at which I am carrying my asset in my balance sheet loses its value, then differential is called impairment loss. For example, if the carrying amount of asset is 1 lakh and I believe that I will be able to realize 80,000, then 20,000 is the impairment loss or impairment provision which I need to record. If inventory is lying in open area and rain has come and damages the inventory, will it be adjusting event? Yes, it will be adjusting event. So if rain is happening subsequently, you cannot have evidence that rain will happen and inventory will be damaged. So it will be it will be a non-adjusting event actually. So in case of rains, because which are happening after the end of the reporting period, we cannot say that event is adjusting event. It is a non-adjusting event. Company receives demand notice from tax department for which appeal and such proceedings might have been possible, which makes it not certain to pay the amount. Since the company got the notice, do they need to take it as an adjusting event? Okay. Now, if the management believes, although they have received the demand notice, but they are very sure that demand notice raised on them is on some wrong grounds, on certain wrong grounds, and they will challenge it and they will get it sorted, then they don't need to provide any provision, not because of Ind AS 10 adjusting or non-adjusting, but because of Ind AS 37. Because Ind AS 37 says when outflow of economic benefits is there, then only we need to provide for, or then only we need to record a provision. So since in this case we are saying that management believes that there will be no outflow because they will get the demand reversed, then definitely there is no provision required. Debtor was solvent at the end of the reporting period. He became insolvent after 1st of April 2020. Is this an event, adjusting event? Okay. So debtor was solvent. Yes. And there were no evidences available of downgrading his credit worthiness or the ratings. Then yes. But it has become insolvent subsequently because of something has happened subsequently only. Then definitely it is a non-adjusting event. I already mentioned it. Impairment loss is not a salvage value. Salvage value is what we realize after the end of the useful life of the asset. So that is the residual value. Impairment loss is the differential between the carrying amount and the recoverable amount. A debtor of 10 crore become bankrupt after reporting period which impact going concern of the seller entity. Okay, is it required adjusting event or non-going concern? Okay, so suppose if there was a debtor from whom company is supposed to receive rupees 10 crore, so 10 crore was the debtor balance, and this debtor 10 crore is so significant for the company that if this debtor doesn't pay, then this company will not be able to survive. So if this debtor has become insolvent, then this company is going to liquidate or wind up. Hence, this company's going concern has hit. So accounts will not be prepared on going concern basis, because standard says whenever management believes that they will not be able to continue the business for next 12 months or for next reporting cycle, then they should not prepare the financial statements on the basis of going concern assumption. Hence, going concern assumption is getting hit. Hence, this is not adjusting or not adjusting. This is going concern which has been hit. Okay, so I am not preparing now my financial statements on going concern basis. Okay, so there are certain questions about the future lectures, about the study material, which I am not able to answer, that you need to contact to the institute only. So let me continue with the next slide. Now, examples of non-adjusting events. Decline in fair value of investments after the end of the reporting period. Decline in the fair value of the investments after the end of the reporting period. Now, as at 31st March, company has an investment in its balance sheet in the shares of, say, Reliance Industries Limited. Okay, Reliance Industries, which is a listed company, share quoted rupees 1600 on the 31st March closing price. So 31st March 2020 closing price is 1600. Okay. Now I will be valuing my investments at fair value. Fair value is the market price listed on the NSE BSE. Okay, so I picked up the fair value from the exchange, which is a 1600. Now on 1st of April or on any of the dates in the April, but before the approval of the financial statements of my company, that is 15th of May, there is a huge fall in the share market. So if share market has fallen in the month of April significantly, and it has eroded the price of the Reliance Industries Limited from 1600 to, say, rupees 1200 or 1000 or 800, whatever is the price. So do I need to account for this difference in my books of accounts for 31st March? No. Because this is a non-adjusting event. Share market has fallen in the month of April. I am preparing accounts for 31st March. As at 31st March, I cannot have evidence that share market will fall in the month of April so significantly that my investments value will be eroded. So these evidences were not available to me. Even I have a sixth sense, and I was somewhere pretty sure that share market is about to fall and price may get eroded. Still, I did not have evidence. So if I do not have evidence and conditions exited at 31st March, then this share market fall cannot be an adjusting event. And for the God's sake, share market fall can never be a adjusting event, because share market is never can never be evidenced before its event, before its fall or rise. So share market fall related items are always non-adjusting events. Declaration of dividends after the reporting period. Okay, so I am preparing financial statements for 31st March 2020, and I have a board meeting on 15th of May 2020 for the approval of these accounts. In that board meeting itself, before the approval of the accounts, board of directors has passed the resolution to propose a dividend. That is called dividend proposed. Okay. Now, do I need to make a provision in my books of accounts for this proposed dividend? No, I don't need to make a provision for this proposed dividend because proposed dividend proposal has come subsequently and this is a non-adjusting event. I cannot make a provision in my books of accounts for the proposed dividend. However, in ICAI, proposed dividends are provided for as a provision, but in Ind AS, these proposed dividends are not provided for as a provision. So this is a difference between ICAI and Ind AS as well. So proposed dividends are never accounted for in the books of accounts if declared after the end of the reporting period, that is after the 31st March 2020. If the dividend has been proposed before 31st March or on 31st March by the board of directors, then definitely I will record it. Okay. Sir, what if we had evidence that debtor has bad credit worthiness, but information about insolvency of the debtor is known after approval of the accounts? Okay. This is a good question. The question is, there was a debtor whose credit worthiness was impaired by the end of the 31st March. That is, the ratings have been downgraded and management was aware. But this debtor has not filed for insolvency or hasn't become insolvent before the approval of accounts and has become insolvent after 15th of May, say 16th of May or 20th of May. My accounts are already approved by the board of directors for issue. So after the approval, I don't adjust. So adjusting events and non-adjusting events are only talking about those events which are occurring within this time framework. If event is occurring prior to 31st March, then this standard is not applicable. If events are occurring after the approval of accounts, then this standard is not applicable. This standard is applicable if and only if the events are happening within this time framework. That is within 31st March 2000, after the 31st March 2020 and before the approval of the accounts by the board of directors in the board meeting, which in our case is 15th of May. Okay. So if events are occurring in this time frame, then only this standard is applicable, otherwise not. Okay, so there is a query that there are chart patterns available for the stocks, and because by looking at the chart patterns, we are able to predict that this stock is about to fall or this stock is about to rise. No, these are not evidences. These are just predictions. These are just indications. These are not evidences. Okay. So unless and until there are evidences, there are conditions that existed, I cannot qualify an event as a adjusting event. And I clearly mentioned that all the events related to share market fall and rise are always non-adjusting events. So please take it as a thumb rule. Now, more examples of non-adjusting events. A major business combination after the reporting period or disposing of a major subsidiary. So, a business combination means I am preparing the financial statements for 31st March 2020. Now, after 31st March 2020, I have acquired or purchased the company and made it my subsidiary. So, I have purchased the company. So, this is a big event for me. Do I need to take the effect of this purchase into my financial statements? No, because this purchase has happened subsequently after 31st March. So, business combination which are happening after 31st March are not to be accounted for within the 31st March balance sheet. They will be accounted for in the year in which the business combination has actually occurred. Okay. Announcing a plan to discontinue an operation. So, if I have 4 types of businesses, say textile business, paints business, or trading business, or any other business or division, and if I discontinued a particular line of operation or particular division subsequently, that is after the year end, then do I need to take effect into my financial statements for this disposal of an operation or discontinue of a division? No, this is an event which is occurring after 31st March, and there were no conditions or evidences available. So these are always non-adjusting events. Okay, these will be accounted for in the year in which they have taken place, that is March 21 only, not March 20. Major purchases of assets, classification of assets as held for sale in accordance with Ind AS 105. So again, same thing. So if I have purchased significant large machineries which are heavy in value terms or very material to my business, so do I need to record all these machinery purchases within March 20 if I have purchased them subsequently? No. All these purchases, all the purchases needs to be recorded as and when they are made. So if the purchases of any assets are made after the 31st March, then they will not be recorded within the 31st March financial statements. They will be recorded in the March 21 accounts only. Similarly, any assets, if I have classified as a held for sale in accordance with Ind AS 105, non-current assets held for sale and discontinued operation, then again the same principle. If I have classified them after 31st March, then I will not adjust my financial statements for 31st March. These are called non-adjusting events, will not take any effect of these transactions or items in my March 20 accounts. Let me see what are the queries. So what happens if Ind AS 10 is non-compliant? Okay, all the Ind ASs for accounting, for measurement, for recognition, for disclosure are mandatory. There are no Ind ASs or no provisions of any of the Ind ASs are recommendatory. All the Ind ASs we have to follow in their entirety. That is accounting, disclosures, presentation, classification, measurement, recognition. Anything and everything written in Ind AS is mandatory, and all the Ind ASs which are notified by the ICAI are mandatory to follow. And if I do not follow any of the Ind AS or even a small portion of any of the Ind AS, then I will be non-compliant with the Ind AS. So definitely, if the merger, business combinations, or these big time events are happening, say in the month of April, then they cannot be planned and concluded in the month of April itself. Definitely, there were discussions happening with among the board of directors or management or senior management of the company within the financial year itself, that we are about to purchase a subsidiary, we are about to dispose a operation. But still, all these events are non-adjusting events, because these events are to be recorded only when they take place. I cannot prepone the accounting of these events which are happening subsequently. Next example, destruction of a major production plant by a fire after the reporting period. So I already told, natural calamities or any other events which are occurring, which are not in the control of the management, then those events are non-adjusting events, like earthquake, like rains, like fire in my godown, or all these kind of events. So these are always non-adjusting events. I cannot tell on 31st March 2020 that a fire is about to happen in my godown on 10th of April. Okay, so I cannot tell this. I cannot certify this. So fire has happened on 10th of April. I was not aware about it. So this is an event which has occurred subsequently. So these events are non-adjusting events. Announcing or commencing. Point number 5. Announcing or commencing the implementation of or a major restructuring. So any of the restructurings or any of the major transfer of shifting of locations or factories from one place to another place, if happening subsequently, then these are the subsequent events only. I cannot say that I am going to shift this so hence I need to account for this in my March 20 accounts. These all these items have to be accounted for as and when they take place. So when the restructuring happens, then only I will account for it. I cannot prepone the accounting of the restructuring which has happened in the month of April. Point number 6, major ordinary share transactions and potential ordinary share transactions after the reporting period. So if I issue any shares, either it is a fresh issue, further public offer, or it is a right issue, or it is a bonus issue. So any sort of issue of share capital after 31st March, that is in the month of April or in the month of May before the approval of accounts, is a subsequent transaction. I cannot record this bonus issue or this right issue or this further public offer in my March 20 accounts, because these events have actually occurred within this time frame only and have to be accounted for only when they actually take place. I cannot do the accounting before the event taking place. Point number 7, abnormally large change after the reporting period in foreign exchange rates impacting foreign currency assets, liabilities, values significantly. Now again, like share market, there is a forex market. So if a dollar rate is fluctuating subsequently, say at 31st March, my asset or liability, receivable or payable in dollars, was recorded at rupees 70 per dollar, which is the closing price on 31st March. And if the dollar fluctuates in the month of April significantly and come to 60 or 80, then I will not take it as an adjusting event, because forex market fluctuations are a subsequent events. They cannot be evidenced or any conditions existing as of 31st March that I know that dollar will fluctuate by this significant amount in the month of April. And even if I know, I cannot provide it as an evidence. Hence, this is equivalent to share market. So any prices which are driven by the free play of demand and supply, and if on those prices I am valuing any assets or liabilities in my financial statements, I am not going to make any adjustment for their subsequent fall or rise in those prices in the free play of demand and supply. Point number 8, changes in tax rates or tax laws enacted or announced after the reporting period that have a significant effect on current and deferred tax assets and liabilities. Now, I am preparing the financial statements for 31st March 2020. Now, in the month of April, say a tax rate has been changed, income tax rate has been changed in the month of April. Do I need to revise my tax liability or deferred tax assets or liabilities for March 20 accounts basis on this new tax rate which has been changed in the month of April? No. If the tax rate has been changed by the end of the 31st March, then I would take it into account, provided it meets the condition of being enacted or subsequently enacted by substantially enacted by the law competent authority. So if the tax rate has been enacted or substantially enacted by the end of the 31st March, then I would be taking the new rate. But if it has enacted or substantially enacted after 31st March, that is in the month of April on any date or before the approval of accounts in the month of May, then I will not take the new rate for the calculation of my tax liability and deferred tax assets and liabilities for March 20 accounts. Commencing 9th point, commencing major litigation arising solely out of events that occurred after the reporting period. So there is a significant litigation which has occurred after the end of the reporting period. So there was no litigation at the end of the 31st March, but in the month of April, there has been a case which has been filed by any of the third party on the company. So this is a new case which has been filed by the third party or by the company on any third party in the month of April. Then this is an event which was not present or there were no evidences as of 31st March. Hence, filing of a new case or receiving a notice of a new case filed against the company by any third party is a new event, and hence it is a non-adjusting event. It will not be adjusted to my financial statements, so I will not account for it. So I hope I have explained many examples to make the concept very clear. Hope there is no doubt left about the adjusting and non-adjusting events. And now I am proceeding with further slides. So first of all, we will do a question which is from RTP for November 19. Let's do this question. ABC Limited received a demand So ABC Limited received a demand notice on 15th June 2017 for an additional amount of rupees 28 lakhs from the excise department on account of higher excise duty levied by the excise department compared to the rate at which the company was creating provision and depositing the same. So what has happened? On 15th June 2017, an additional demand notice for rupees 28 lakhs is received by the company from excise department on account of higher excise duty levied by the excise department compared to the rate at which the company has created a provision for depositing the same. So I am preparing the financial statements for 31st March 2020. I am receiving a notice from the excise department levying additional excise duty or excise duty at higher rates on 15th June. So 15th June I am receiving notice. March 20 accounts I am preparing. Or sorry, March 17 in this case. The financial statements for the year 16-17 are approved on 10th of August. So 10th of August is the date when Board of Directors have approved the financial statements. So time frame is from 31st March 17 to 10th of August 17. If any events occur between this time frame, then between these two dates, then this is an event occurring after the reporting period, and my event is occurring on 15th June, which is well in this time frame. Now in July 2017, the company has appealed against the demand of rupees 28 lakhs, and the company has expected that the demand would be settled at rupees 15 lakhs. So in July, that is again before the approval of accounts. Approval of accounts is happening on 10th of August. So in the month of June, I have received a notice. In the month of July, I have prepared a reply to this demand, and company expects that demand would not be 28 lakhs. It will be settled at 15 lakhs only. So company believes that since demand letter is received for 28 lakhs, but as per our assessment, only 15 lakh is payable. So how the above event will have a bearing on the financial statements for the year 2016-17. Now the question is whether this event is an adjusting event, that is, do I need to create a provision in my books of accounts for March 17, or this event is a non-adjusting event and I don't need to create any provision. Please let me know. If anybody wants to answer, they can answer in the query box so that I will be able to see what are your answers before we jump on to the solution. Because we have done so many examples about adjusting and non-adjusting events, so I hope this question from RTP should be solved by you. So one reply from Kunal has received Mumbai non-adjusting. Okay. Any other replies anybody wants to make? Let me wait for 30 seconds, then I will come to the solution. So somebody has responded, this is an adjusting event. Okay. Non-adjusting. Okay. So let's see the solution. It was a non-adjusting event because it has no indication at the end of the reporting period. So somebody from Tamil Nadu reported that this event is a non-adjusting. Let's see what is the solution, and then we will understand the reason. In the instant case, the demand notice has been received on 15th of June 2017. Okay. So demand notice has been received on 15th June, which is given in the question itself, which is between the end of the reporting period, that is 31st March 2017, and the date of approval, that is 10th of August 2017. So this event has occurred between this time frame. Hence, this is an event occurring after the reporting period. Therefore, it is an event after reporting period. This demand for additional amount has been raised because the higher rate of excise duty levied by the excise department in respect of those goods which have been manufactured during the reporting period. So by the end of 31st March, I have already manufactured the goods and excise duty is levied on manufacturing. So goods were ready, goods were manufactured, and excise rate has been, excise department has charged the excise duty with higher rates on these manufactured goods which have been manufactured by the 31st March. So goods were completed or completely manufactured. So excise duty should have been paid, or liability should have been recorded for the excise duty. Accordingly, condition exists as at 31st March as the goods have been manufactured during the reporting period. So point of levy of excise duty is on manufacturing. The day I complete the manufacturing process of a particular good, the excise duty has become payable on manufacturing, irrespective of the fact you sell it or you don't sell it. Okay. So goods have been manufactured by 31st March. So point of levy of excise duty or condition for levy of excise duty is complied with. Hence, liability should have been recorded. Now, excise department has levied excise duty on these goods which have been manufactured by 31st March with an additional excise duty rate. So this event is confirmed by the receipt of the demand notice later on. So goods I have manufactured by the end of 31st March. So goods were there. Liability should have been recorded. Excise department has served a notice of demand to levy excise duty on these goods. Hence, this notice is an event which is confirmed by the serving of the demand notice. So, serving of the notice is the confirmation of the event of levy of excise duty on these goods, because goods were already manufactured. I know that goods are manufactured, I have to pay excise duty. So, liability should have been accounted for. Therefore, it is an adjusting event. In accordance with principles of Ind AS 37, the company should make a provision in the financial statements for the year 2016-17 at the best estimate of the expenditure or liability to be incurred, that is 15 lakhs. Now, so there are two standards which are getting involved in this fact pattern. First standard is whether this demand notice will be an adjusting event or not. Yes, demand notice is an adjusting event because goods have already been manufactured by 31st March, and a condition for levy of excise duty has already been complied by 31st March. Okay, now notice has come. So confirmation has come to me that yes, liability is now to be discharged. It is raised by the department. So that is a confirmation of an event. So this is an adjusting event. Now, Ind AS 37 says that the provision should be made in the books of accounts at the best management estimate. Now, in the given facts of the question, management estimates that against 28 lakhs demand, only 15 lakh is payable and it will be settled by 15 lakh. So they have a best management estimate, or say through some legal opinion, that 15 lakhs should be payable on this. Then Ind AS 37 allows, instead of making a 28 lakh provision which is raised by the excise department, we only need to make a 15 lakh provision which is the best management estimate. Okay, so this is allowed by Ind AS 37 or required by Ind AS 37 rather, that we need to make the provision for the best management estimate. So hence 15 lakh adjustment would be made to my accounts. So adjusting event is because goods were there and event has been confirmed by the serving of the notice of the demand. Ind AS 10 is complete now. Now I move to Ind AS 37 to see for how much amount I need to make a provision. So Ind AS 37 gives me answer. It says best management estimate, and best management estimate is 15 lakhs only. So I will be recording a liability for excise for rupees 15 lakhs. Okay. So this is an adjusting event. So Pallavi Agarwal has answered it correctly, that provision of rupees 15 lakh will be made from Calcutta. Nice. Now there are some special issues. Para 3 of Ind AS 10. Para 3 of Ind AS 10 says whenever there is a breach of a material provision of a long-term loan arrangement on or before the end of the reporting period. Okay. Now suppose I have taken a loan of rupees 10 crores from HDFC Bank, and there is a long agreement which has been signed by both the parties, that is the company who has taken the loan and the HDFC Bank, the lender. And in that agreement there are certain conditions which needs always to be complied by the borrower. Okay, these conditions are called covenants of the loan agreement. Okay, now if any of the covenants has been breached by the party, the borrower, then HDFC Bank lender has the right to demand the full loan immediately. So HDFC reserves the right to demand this long-term loan, say for 10 years. If HDFC Bank has given a loan for 10 years, but it says that as per the agreement agreed, if you break any of these covenants, then I have the right to demand my full amount back immediately, then and there, as and when you break the covenant or do not comply with any of this covenant or provision. Now, this is the example. Now, what Para 3 of Ind AS 10 says, Para 3 of Ind AS 10 says, whenever there is a breach of a material provision of a long-term loan arrangement on or before the end of the reporting period. My reporting period is 31st March 2020. I have taken loan, say, somewhere in 2019. Now, before 31st March 2020, I have made a breach of any of these material covenant which gives the right to HDFC Bank to demand full loan amount of rupees 10 crore immediately, and I have to pay it, okay, if it demands. Now, with the effect that the loan liability becomes payable on demand on the reporting date. So I have made a breach on or before 31st March. HDFC Bank has the right to demand the full loan. And the agreement by the lender before the approval of the financial statements for issue, that is the waiver received from the lender before the board date. Now, I am preparing my accounts for 31st March 2020. My board meeting is happening or scheduled to happen on 15th of May 2020. So this is 1.5 months is the time frame in which if I go to HDFC Bank and request that, sir, please provide me a waiver that you will not demand the loan immediately and do not cast any liability on me to pay this loan immediately. And if HDFC Bank relaxes me from this demand of loan, full loan, then only I can present that loan liability in my books of accounts as a non-current liability. Otherwise, this liability should have been presented as a current liability, because at 31st March 2020, I have made a breach of a material covenant which entitles HDFC Bank to demand the full loan amount, and hence the loan is becoming immediately payable. Immediately payable means within next 12 months from the reporting date, that is current liability. So the non-current liability, which was 10-year loan, should have been reported as a current loan only, because it has now become repayable immediately. So this is a current. But now, after the end of the 31st March and before the 15th of May approval of my accounts, I requested HDFC Bank to waive this. And if he waives and gives me a no objection certificate, then I will continue to present this loan as a non-current. Hence, it is called an adjusting event, because by the demand, the event, the loan has become current. I should have presented it as a current liability, but by obtaining the waiver subsequently, I am again getting the rights to present it back as a non-current only. Hence, the classification will change again back to non-current. So this is an adjusting event. So let's understand with this table that when and how this transaction happens. Suppose the breach has happened before the year end, that is before 31st March 2020, I have made a breach of a material covenant which entitled HDFC Bank to demand the loan immediately. Now, timing of waiver on or before the year end. So suppose I made a breach on 31st March, I immediately went to HDFC Bank and asked for a waiver. They allowed me a waiver in writing. They given me NOC that they will not demand the loan on the 31st March itself. Then the liability will be classified or presented as non-current only, because I made a breach, I got a waiver before 31st March itself, and hence nothing to do with. So it was non-current. Had I not breached, it become current because I breached. It become again non-current because I got a waiver before the 31st March. So it is a non-current now. Now breach has happened again on 31st March or any date before the 31st March. But I got a NOC from HDFC Bank after 31st March. That is 1st April to 15th of May. On any of the dates between these two dates. Then receiving the notice or receiving the waiver relaxation letter or NOC from the HDFC Bank between this period is an event occurring after the reporting period, yes or no? Yes, event occurring after the reporting period. Now, we need to classify this event, whether this event is an adjusting event or a non-adjusting event. So if this event is an adjusting event, then I will adjust my accounts. If this event is non-adjusting events, I will not adjust my accounts. Then, waiver notice is received say on 10th of April. Now, para 74 of Ind AS 1, breach of a material covenant. Again, please, I am highlighting it again. This para 74 is not of Ind AS 10. This is the para 74 of Ind AS 1, which you must have studied in your lecture 1. That if there is a breach of material covenant, then how to deal with this. But because Ind AS 10 also covers this aspect, so Ind AS 10 is also discussing about this impact, this item. So Ind AS 1 para 74 and Ind AS 10, both the standards are talking about this item. So waiver is receiving a waiver I have received after the 31st March before the approval of the accounts. So again, this event is a adjusting event. That is, I will timing of waiver is on or before the year end for a period less than 12 months after the year end. So it will be reflected as a current. Now, if the breach has happened before 31st March or on or before 31st March, and waiver has come to me for minimum period with 12 months, then this event is an adjusting event and liability will be continued with a non-current. So in second scenario, HDFC Bank has waived, but waiver says that I am not waiving it for completely. I am only waiving it that don't pay immediately but pay within 12 months. So if pay within 12 months, then it is equivalent to non-waiver because it is a current for me. So I will continue to present the liability as current. But if the waiver is coming that, okay, so I restore back to the original condition, that is you pay in 10 years only, then I got a complete waiver. So in that case, it will be continued as a non-current. Now, what if I get the waiver after the approval of accounts? So that is an event which is not covered by the Ind AS 10, because Ind AS 10 covers only those events which are happening between the reporting end of the reporting period and the approval of the accounts. So if I am getting the waiver after the approval of accounts, then definitely it is an event outside the scope of this standard, and hence I will present this loan liability as a current only, because I did not get waiver before the approval of accounts. So in that case, it will be current only. Now, before going to the going concern, I think let's do some questions first. I hope the question is visible to everybody, which is in a different file PDF I have just opened.
So file is not visible.
Sorry, the screen is visible. Question is visible to everybody.
No.
It is not visible.
No.
Okay, let me.
Mansukh, आप बताएं.
Now it is visible.
Not yet.
Okay, let me stop sharing again and do the sharing again. Now it is visible.
No.
This PDF is not visible.
No. You have already opened it first?
Yes, PDF is already opened.
It is blank.
So what is visible on the screen?
Blue plain screen. Blue plain screen is coming.
Okay. And now?
No.
It is not visible PDF. Okay, let me open the Word file of it. No problem. Hope Word file is visible. Now it is visible. Yes, I am doing it. I hope this is visible now. Okay, do I need to increase the size?
Yes, sir. Yes, sir.
Sufficient?
No, sir. More. थोड़ा और कर दीजिए.
Sufficient?
Yeah.
Thank you. So let's do this question, and this is from November 19 CA final examination paper for 8 marks, full-fledged question on Ind AS 10 only. Discuss with reasons whether these events are in the nature of adjusting or non-adjusting, and the treatment needed in light of the accounting standard Ind AS 10. So The question is asking, so first of all, students, please, whenever you writing an exam, carefully understand what the question is asking for. The question is saying discuss with reasons. So you only need to provide an answer. What is your opinion, that is adjusting or non-adjusting, along with the reason that why it is adjusting and non-adjusting. So discuss with reason whether these events are in the nature of adjusting or non-adjusting and the treatment, and then tell what is the treatment. So how it will be adjusted in the light of India's 10. So question is very clearly mentioned, India's 10 you need to apply. Okay. Now point number 1, Moon Limited won an arbitration award on 15th April 2019 for rupees 1 crore. So Moon Limited won an arbitration award on 25th April 2019 for rupees 1 crore. 25th April 2019 is which date? April month date. I am preparing accounts for 31st March 2019. So this date is coming after the end of the reporting period. Okay. From the arbitration proceeding, it was evident that company is most likely to win the arbitration award. Okay. So 21st 2019 is the date, and it is most likely to win the arbitration award. Okay. The directors approved the financial statements for the year ending. Year ending is 31st March 19. Okay. And on 1st of May 2019. So 1st of May is the board meeting on which the accounts are getting approved. 31st March is the end of the reporting date. 25th April, that is the date of arbitration award decision, is falling between these two dates, that is 31st March 19 and 1st May. Hence, this is an event which is occurring after the reporting period as defined by the India's 10. The management did not consider the effect of the above transaction in financial year 2018-19. So for the 18-19 financials, management has not yet considered the effect of this arbitration, as it was favorable to the company and the award came after the end of the financial year. So management believes that since the award is favorable to us and it has come after the end of the year, hence we are not going to account for it. Now question says discuss how this event should be dealt with along with the reason, and what would be the treatment which you will be giving effect in your financial statements. Now what is the effect of this transaction? Please answer in the query box so that I get to know you are participating in all these questions. So first of all, you only need to tell me in your comment box whether it is adjusting event in your opinion or it is a non-adjusting event. First of all, tell me this thing, then tell me the reason, and then tell me what is the amount. If it is an adjusting event, you will be adjusting the financial statements and how. So that is all the ask from this question. And since I have already mentioned this question is for 8 marks and this question contains 1, 2, 3, 4 situations. So 4 situations for 8 marks. So 1 situation for 2 marks. Okay. So you don't have much time. Most probably you should answer it in your exam by the 180 seconds or 2 minutes at max. 2 minutes to 3 minutes you should take to answer this question maximum. So one of the reply has come to me from Varanasi or from Hyderabad. It is adjusting event. Okay. Please send your replies fast so that you get to know whether you are assessing the situation correctly or not. If I simply jump onto the solutions, then you will not be able to apply your mind, or you will not be able to do the brainstorming with the facts of the question. So I will be waiting for only 30 seconds more, then we will be discussing. Kathmandu, Nepal, Vikas Gupta has replied, this is an adjusting event. Okay. Then Kajal from Ankleshwar replied, events confirms that the entity had present obligation at 31st March 2019. Adjusting event should be accounted as a receivable in its books. Okay. So let's see. One more reply from Delhi. It is an adjusting event as events can be of favorable or unfavorable. So management have to adjust this. Provision of rupees 1 crore is adjusted. Okay. Let's see the solution. As per Ind AS 8, the treatment of stated issues would be as under. It is an adjusting event. So we are talking about the first event which we have just discussed. It is an adjusting event as it is the settlement after the reporting period of a court case that confirms that the entity had a present obligation at the end of the reporting period. Even though the winning award is favorable to the company, it should be accounted for in its books as a receivable since it is an adjusting event. So 1 crore will be accounted for as a receivable in the books, or if the management had provided for any provision earlier, then that provision will be reversed. Let's move to the next question. Zoom Limited has a trading business of mobile phones. So they are into the trading business of mobile phones. The company purchased 1000 mobile phones at rupees 5,000 each on 31st March 2019. So 1000 mobiles they have purchased. Each mobile costed them rupees 5,000, and the purchase has happened on 15th March 19. Means purchases are happening before the end of the reporting period. That is before the end of the 31st March 2019, for which I will be preparing the accounts. The manufacturer of the phones had announced the release of the new version on 1st of March 2019, but had not announced the price. So manufacturer is like, say for example Samsung. Samsung has announced that they are launching, or they have released a new version on 1st of March 2019. So on 1st of March 2019, Samsung had already announced a new version. So on 15th March, while making purchase, I have purchased some model, but an announcement had already been made prior to that date on 1st of March itself that a new version has already been released, but the price was not released for the new version of mobile phone on by that time. Now Zoom Limited has valued the inventory at cost. So Ind AS 2 says cost or NRV, whichever is lower. So Zoom Limited had valued the inventory at cost of rupees 5,000 at the year end 31st March 2019. Now due to arrival of new advanced version of mobile phones on 8th April 2019. So what has happened? Samsung company, the manufacturer, had announced that new version is released on 1st of March, but they haven't announced the price. But on 8th April, they have announced the price. So price announcement of that version, which had been released on 1st March, is rupees 4,000 each. Okay. the financial statements of the company. Which company? Zoom Limited. Valued the mobile phones at rupees 5,000 each. So they have valued the inventory at cost only and not at the value of rupees 4,000 less expenses on sale. That is NRV. This is called NRV, net realizable value, 4,000 less expenses on sales. As the price reduction in the selling price was effected after 31st March. So Zoom Limited says that since the price announcement has happened after 31st March, hence they will not account for it and they will not lower their inventory value from 5,000 each to 4,000 each. What are your thoughts? Whether Zoom Limited should account for it by classifying this event as adjusting event, or whatever the treatment they have already done, that is not to account for the decrease in the price, treating this event as a non-adjusting event is correct. So one of the reply from Chennai is received. So Arun replied, adjusting event because situation prevails before the reporting period, that is adjustment. Okay, this is for the previous question. So we are on the question number 2, fact pattern number 2 of the same question. So what do you believe? It is an adjusting event or non-adjusting event? Throw your comments in comment boxes fast so that I will be able to see that you are grasping what I am trying to, make you understand all these concepts. So I'm just waiting for 15 seconds, then I will discuss the solution. So somebody from Chennai has responded that it is an adjusting event. Okay. So somebody believes it is an adjusting event. Anybody else? Or anybody who believes that it is a non-adjusting event? Okay, so let's see the solution. The sale of inventory after the reporting period may give evidence about their net realizable value at the end of the reporting period. Hence, it is an adjusting event as per Ind AS 10. So, Ind AS 10 says that if you are selling any inventory subsequent to the year end at a lower price, then it means that your inventory had already been impaired by the end of the reporting period. So Zoom Limited should value its inventory at rupees 4,000 and not at 5,000. Hence, appropriate provision must be made for rupees 1,000 for the quantity they have held in the inventory. So this is an adjusting event because the price has been dropped subsequently and the model had already been announced within the year end. So there were evidence, there were conditions existing at the end of the reporting period that new model has already arrived. So this may have an impact on my model which I have purchased, and subsequently the announcement of lower price for the new model made an impairment on my mobile phones which are of older version and high priced. Hence I need to make a provision for the write down of my inventory value by the differential amount. So I have received 4 to 5 replies quickly, and everybody is saying that these event is adjusting event and inventory should be valued at 4,000 only. So correct all the replies are correct. Okay, let's move to third fact pattern. There is an old due from a debtor amounting to rupees 15 lakh from whom insolvency proceedings was instituted prior to the financial year ending 31st March 2019. The debtor was declared insolvent on 15th of April. So I had a debtor at 31st March owing 15 lakhs from him, and the debt in proceedings have been insolvency proceedings were initiated against him. However, he has been declared insolvent on 15th of April. So, is this an adjusting event or not? So, what are the dates of my approval? 1st of May. So, before 1st of May, on 15th of April itself, the debtor had got declared insolvent. So this is a confirmation of an event that the debtor has become insolvent whose creditworthiness was already impaired because insolvency proceedings were already initiated prior to the year end. So if insolvency proceedings are initiated, it means its creditworthiness was already impaired, so it is an adjusting event, and I need to make a provision of rupees 15 lakh if I believe that full amount will now not be received. So how much provision do I need to record in this case depends the best management estimate that what management believes how much they will lose and how much they will receive. So India's 37 again will come into the picture for making that best estimate. So if management believes that 12 lakh will be not received or will be bad, then 3 lakh will be received. Then 12 lakh will be the provision to be made on this provision for doubtful debts under India's 37. Last fact pattern of this question. Assume that subsequent to the year end and before the financial statements are approved, company's management announces that it will restructure the operation of the company. Management plans to make significant redundancies and to close a few divisions of company's business. However, there is no formal plan yet. Should the management recognize a provision in the books if the company decides subsequent to the end of the accounting year to restructure its operations? So again, assume that subsequent to the year end and before the financial statements are approved, company's management announces. So company management is announcing a restructuring plan after the year end and before the accounts are approved. Okay, so it is given management plans to make significant redundancies and close a few divisions of company's business. However, there is no formal plan yet. So there is no formal plan. It is just in their minds that they will do it. But there is no formal paper is prepared yet or not approved by the competent authorized persons. Should management recognize this provision in the books or not? So do you believe this event is an adjusting event or do you believe that this event is a non-adjusting event? Please throw your answers in the comment boxes. So one of the answer from Pooja Sani is received. It is a non-adjusting event to make provision amount to be quantifiable, but in this case it can't be quantifiable, therefore no provision is required. So they are saying it is a non-adjusting event because provision is not quantifiable. Okay. Anybody else? Fast students, you have to solve all these 2 marks each fact-based scenario within 2 to 3 minutes in your examination. So I'm just waiting for 15 seconds, then we will discuss the solution. So Prakhar Jain has responded from UP that this is a non-adjusting event because there is no formal plan available. Okay. Somebody from Kalananda is responded non-adjusting event because there is no condition on the balance sheet date. Okay. Anybody who believes that it is an adjusting event, because all the responses are coming for non-adjusting events only. So is there any contrary view? Okay, let's discuss the solution. Again, one more reply, non-adjusting. Okay. So this is a non-adjusting event. Why? Announcing or commencing the implementation of a major restructuring after the reporting period is a non-adjusting event as per Ind AS 10. So announcing or commencing the implementation of a major restructuring after the reporting period is a non-adjusting event. So hope you remember we have discussed already these while during the discussion of literature of Ind AS 10, that whenever a company announces any major restructuring or any major acquisitions or disposal of any other companies, divisions, line of operations, all these major activities are to be accounted for as and when they take place. We do not prepone the accounting of these major items to the previous financial statements, because these events are non-adjusting events as per Ind AS 10. Though this is a non-adjusting event occurred after the reporting period, yet it would result in a disclosure. Yes, because I have already told you that disclosure has to happen for non-adjusting event as well. So in notes to accounts, we will be disclosing what restructuring is all about, this, when it is about to take place, what is the timing of this restructuring, all these facts and figures about this restructuring plan we will be making as a part of our disclosure in the notes to accounts, but we are not doing any accounting or we are not adjusting our financial statements for these events. And again, this disclosure is also required only if the restructuring is material. So if any non-adjusting event which is a material event, then only disclosures are required. Otherwise, we will not do any disclosures as well. This would not require a provision, since as per Ind AS 37, decision to restructure was not taken. Okay, so provision is needed only when decision has been taken. But right now, management is only thinking. They do not have any formal plan to do this restructuring. They are only discussing about this. They are checking whether it is beneficial or not, doable or not, legally permissible or not, financially feasible or not. All these parameters they are assessing. They have not come up with a decision or a formal plan to do this. Hence, there is no provision required in the reporting date as per Ind AS 37 as well. Hence, it does not give a rise to any constructive obligation at the end of the reporting period to create any provision. So this event is a non-adjusting event. Let's move to the next question. This is a case study. So on 29th of January 2005, H discovered that its warehouse was damaged. So warehouse is damaged on 29th of January. The warehouse was constructed by H Limited at a cost of rupees 10 lakhs in 2010. It first became available for use by the entity on 1st of January 2001. So in January 2001, it was made available for use. During early February 2005, An investigation revealed that damage was due to a structural fault in the construction of the warehouse. Okay. So let's reread the facts. On 29th of January 2005, H Limited discovered that its warehouse was damaged. So discovery about the damage has come to light on 29th of January 2005. The construction has happened in 2001, January 2001, and cost was 10 lakh. And in early 2005, an investigation revealed that this damage, which has come to light on January 2005, in February when we investigated it further, we come to know that there was a structural fault in the construction of the warehouse. There was a structural fault in the construction, and construction was happened in 2001. So since 2001, there was a fault. Okay. The fault became apparent when the building leaked severely after heavy rainfall. The fault became apparent when the building leaked severely after heavy rainfall in the week ended 27th January 2005. Okay. So let's restructure the dates. On 1st of January 2001, construction has happened. On 27th January 2005, rainfall has happened, heavy rainfalls. On 29th January, that is after 2 days of the rainfall, they come to know that warehouse is damaged severely. And in February 2005, after 1 month or after few days of 29th January, a team investigated and noted that damage has happened because there was a structural fault in the construction, original construction itself. Okay. The discovery of the fault is an indication of impairment. So H was required to estimate the recoverable amount of its warehouse at 31st December 2004. So the discovery of the fault is an indication of impairment. So H was required to estimate the recoverable amount of its warehouse at 31st March 2004. Okay. This estimate was rupees 6 lakhs. So 6 lakh is the estimate for this recoverable amount. Further, H reassessed the useful life of its warehouse at 20 years from the date it was ready for use. So 20 years from the ready for use. When it was ready for use, 1st of January 2001. So till 31st January 2020, it is expected to be used. Before discovering the fault, H Limited depreciated the warehouse on a straight line method to a nil residual value over its estimated 30 years useful life. What happened? Before discovering the fault, H Limited depreciated the warehouse on a straight line method to nil residual value over its estimated 30 years useful life. So here 30 years was the original life. Okay. So 30 years was the original life, but because of this damage, they have revised the life of 20 years and they were depreciating it on 30 years using a nil residual value. So residual value was nil. So these are the facts. Now, rain damage from seepage through the crack in the warehouse caused inventory with a cost of rupees 1 lakh to become unsaleable. Now because this warehouse is damaged and rainwater has come inside, inventory costing rupees 1 lakh become unsaleable. So inventory is also damaged. Okay. So inventory costing rupees 1 lakh is unsaleable now. All of the damaged inventory was on hand at 31st March 2004, 31st December 2004. So we are preparing the accounts for 31st December 2004. So our year is from 1st of January till 31st December. Okay, and 2004 is the year for which we are preparing the accounts. H is not insured and there is no insurance against any losses. Okay, no insurance was available. It accounts for all its property, plant and equipment under cost model. So warehouse or has been accounted for at cost model under India 60. So these are the facts of the question. Now, what all you need to do in this question? You just let me know. So these are the facts. Now we need to give a solution. What are the things which we need to identify and discuss about these facts in order to get the solution or the adjustment for these facts which is required to be made in the financial statements. So somebody has responded, this event is an adjusting event. Okay. Any other answer? Any other answer? Anybody who believes that there is something else as well in this question apart from adjusting and non-adjusting? I'm just waiting for 10 seconds. Adjusting event, depreciation should be calculated again, or depreciation should be again calculated. Okay. So Hyderabad people are responding very quickly. What about other states? Okay, so let's discuss with the solution. So first of all, the question was asking prepare journal entries or accounting entries to record the effects of these facts which are mentioned. Okay. Now, on 31st December 2004, that is the end of the reporting period for which we are preparing the accounts or the balance sheet or the financial statements. We will debit profit and loss account, that is depreciation expense, to credit accumulated depreciation, that is impairment. So 19608. How this amount is calculated? Let's see in the notes. So the cost of the warehouse was rupees 10 lakh and original life was 30 years useful life. So 33,333 was the depreciation we were charging on this warehouse in our books of accounts basis on the original estimate. Okay. Now carrying amount as at the end of 31st December 2003 is 9 lakh. How 9 lakh has been arrived? 10 lakh the cost minus the nil residual value, because residual value was nil originally, divided by 30 years. So 33,333 is the per year depreciation and 3 years have passed. So 3 into my 33,333. So 9 lakh, 1 lakh is the depreciation. So 10 lakh minus 1 lakh is equal to 9 lakh is the carrying amount as at 31st December 2003. Here I am reading. Now 9 lakh is the revised carrying amount. Now basis on this revised carrying amount, I will be recalculating my depreciation for the remaining useful life which is now 20 years minus 3 years, that is 17 years. Now 17 years is the remaining useful life, and 9 lakh will be divided by 17, so depreciation will come to 52,941 per annum for next 17 years because SLM approach is followed. Now this 52,941, I need to pass a journal entry sorry, 52,941 is the revised depreciation, and original depreciation was 19,608. So I will deduct original depreciation from this, and the balance I will pass an entry. So here I will pass an entry to recognize the additional depreciation expense for the year end 30/2004. Okay, so this is the additional depreciation I am passing or recording in my books of accounts for year ending 31st December 2004. So this is the first entry which I am making. So this is the first entry. Now what is the next entry? Profit and loss debit impairment expense to credit accumulated depreciation impairment. How we have calculated this? So carrying amount, how much was the carrying amount before testing for impairment? Less. 6 lakh is the recoverable amount, 10 lakh was the original cost, 9 lakh was the carrying amount. So I will recalculate the carrying amount. Carrying amount is 9 lakh, the original carrying amount, minus depreciation calculated above, that is the revised depreciation for the year end 31st December 2004. So revised carrying amount, which was 9 lakh earlier, has now become 8,47,059 rupees. It is the revised carrying amount. Now my recoverable amount given in the question is 6 lakh, and applying Ind AS 36 impairment of assets, what it says, we need to record a impairment loss if recoverable amount is lower than the carrying amount, and carrying amount is cost minus till date depreciation. So till date depreciation I have deducted. So my revised carrying amount is 8,47,000 and recoverable amount is 6 lakh. So differential will go as a 2,47,000 as an impairment loss for the year ended December 2004. So this is the impairment loss which I need to record additionally because of the application of Ind AS 36. Okay, so I have passed this entry. On 31st December 2004 itself, that is the end of the reporting period, that debit P&L impairment loss, credit accumulated depreciation impairment. So 2,47,000. Now these are the two entries which I have passed for the adjustment of my warehouse because of this heavy rains. Okay, now the damage, let's discuss. The damage to warehouse is an adjusting event. The damage to the warehouse is an adjusting event after the end of 2004 reporting period, as it provides evidence that the structural fault exited at the end of the reporting period. Now, I have told you that we need to have some evidence available as on the reporting date in order to classify a subsequent event as an adjusting event. Now subsequent event is getting the rainfall, heavy rainfall, but rainfall in itself was not an event or what not in its sufficient to damage the warehouse had warehouse was not structurally faulted. So because of this structural fault which already was existing in the warehouse, and because of that fault only rain could have damaged this. So these there were evidences of this structural fault. Hence this event has become adjusting event because of this structural fault which was already there since the inception of the construction. Notwithstanding that it was discovered or become apparent after the date. So it has just come to our light after 4 years of construction that there is a fault. It has no impact on the classification of the event as a non-adjusting event, because event is adjusting, evidence was there. It's just that we did not see it earlier, we only saw it now. The effects of the damage to the warehouse calculated below are recognized in 2004 reporting period. Prior periods will not be adjusted because those financial statements were prepared in good faith. So is there any error that there was a fault already there, so we should have do the error correction, because earlier accounts should have also have the same impact? No, there was no error because all the accounts were prepared in good faith. We were not aware about this structural fault. This structural fault has come to our light because of this heavy rain, and the heavy rain could have damaged the warehouse only because there was a structural fault. Otherwise, the rain couldn't have damaged the warehouse. Hence, it is a event existing at 2004 already and confirmed by the rainfall damage. Now, if the damage to the warehouse had been caused by an event occurred after 31st December 2004, example in this case, in case there was no structural fault, then this event was non-adjusting event. So, if there was no structural fault and rain has happened and damage has happened, then we will treat this event as a non-adjusting because there was no fault. Okay, there were no conditions, there were no evidences of the event. So since there was a structural fault, it has become adjusting. Otherwise, it would have been non-adjusting if there was no structural fault. Okay. Now, rupees 1 lakh rain damage to inventory occurred during 2005 only. It is a non-adjusting event. So, adjusting for warehouse but non-adjusting for inventory, because for inventory there were no evidences available. Okay, so inventory 1 lakh provision for the damage to the inventory value, we will not do the accounting because it is a non-adjusting event. For inventory there were no evidences or conditions exited. Only for the warehouse the conditions exited. Hence, for warehouse it is an adjusting event, for inventory it is a non-adjusting event. And if warehouse there was no structural fault, then for warehouse as well it would have been non-adjusting. Hope I made the answer very clear on about this question. If any doubt, please raise the query immediately. Otherwise, I will move to question number 3. I am just waiting for 30 seconds so that if anybody has any sort of query or doubt relating to this question, then we can discuss it right away. So no queries, no questions. Everybody understood the question. Everybody understood the question and the facts of the question and solution and comfortable with the understanding. Great. Okay, one query has come to me. Could you please let me know why we are taking depreciation adjustment of 19608 for only 1 year and not 3 years, as we charged lower depreciation for 3 years? Okay, so the question pertains to the depreciation. So yesterday only we have studied Ind AS 8, and in Ind AS 8 I made it very clear that whenever we change any residual value or remaining useful life for any of the property, plant and equipment, then it is a change in management estimate, and change in accounting estimates are always accounted on prospective basis, not on retrospective basis as per Ind AS 8. And since this is a change in accounting estimate only, I have just changed the estimate of the useful life of the warehouse. I have just changed the life estimate only. Okay, so I will be accounting for the depreciation from the date of this change in the useful life of the estimate. Hence, prospective application, no retrospective. I will not recalculate the depreciation for past 3 years and charge it in the previous years, or take any retrospective effect in the retained earnings. Hope answer is clear to you. Anybody else? So basically this was a full case study which involved Ind AS 16 application PP&E, Ind AS 8 application change in management estimate, Ind AS 10 application adjusting event, non-adjusting event because of the structural fault and the rain, and Ind AS 36 impairment of property, plant and equipment, or impairment of assets, where we have compared the carrying amount, revised carrying amount with the recoverable amount given in the question, and the shortfall we have recognized as a impairment loss. So there were 4 standards which were subsumed in this case study. Okay, next question is, in the given question, it is stated that goods were not in the saleable condition. In the answer, it is given that goods are in good position and not adjusting event. Why it is so? No. So it is not about goods are in good position. So because of this rainfall, warehouse got damaged, and because of the damage of the warehouse, inventory got damaged, and now inventory is not saleable. Hence, 1 lakh inventory will be realizing nil value, 0 value. So I have I will treat this as a non-adjusting event because a rain has happened subsequently and there were no events. So I will not be adjusting 1 lakh to my inventory. But I am not saying that inventory is in good condition to sale. So inventory is not in a good condition to sale, but this 1 lakh loss or provision on inventory I will not record in December 2004 accounts, but I will record in December 2005 accounts, because the event is a non-adjusting event and has occurred in the period of January to December 2005, and since it is in the nature of non-adjusting, I cannot adjust 2004 accounts. Next question, if insurance of this goods is done, then what will be the treatment? Is there any treatment of non-insurance? Okay, so as the facts of the question says that there was no insurance. So since there was no insurance, all the loss will be borne by the party only, the company only. So if there is any loss, they will account for it. But if there was an insurance, then what we will do in the next period against the 1 lakh inventory, I will be booking 1 lakh full provision. But if there was an insurance and I believe that insurance company will say pay 80,000, then 20,000 only I will be providing for, because I will be receiving 80,000 from the insurance company as a best management estimate. So best management estimate in that case would have been 20,000 loss only, not the 1 lakh. Okay. So somebody has asked, should Ind AS 8 also be mentioned in the answer? Will that carry extra marks? So students, please make a note of it. If you are pretty sure about the number and name of the Ind AS, then only write that in light of Ind AS 8, this is required to be done. But if you are not sure, then please don't write it, because in that case, if your Ind AS number or Ind AS name is wrong, but your answer is correct, examiner may have an oversight error understanding it that your answer would be incorrect also, because you have put a wrong reference. So if answer is expected to be in line with Ind AS 8 and somehow by mistake you have mentioned Ind AS 10, then examiner will think that you have written a wrong answer. So you get a chance to lose marks if you give a wrong reference. Extra marks you will gain or not, I do not know, because the question is for 8 marks. If you answer it correctly, even without putting the name or number of the standard, then you will get the full marks, what I believe. Marks are for the correct answer and correct reasoning, not for the references of the name and number of indices. But yes, it will give a good impression to the examiner. If you are sure, you can write it, and if you have time, you can write it. So inventory valuation, why inventory valuation is non-adjusting event? Somebody asked again. Let me explain it again. So inventory, for inventory, there was no conditions or evidences existing as of 31st December 2004 that rainfall will happen and inventory will get damaged. Inventory has been damaged only because of the rainfall. There were no evidences. So it is a non-adjusting event. But warehouse was structurally faulty. Hence, it was about to damage if the rainfall or any other thing, any other events like rainfall has happened. So in that case, we have taken it as an adjusting event, but for inventory, it is a non-adjusting event. And for warehouse as well, I already told that it would have been non-adjusting had there was no fault in the construction of the warehouse. So hope the question is very clear. Let me move to question number 3. State Limited was being sued for an anti-competitive behavior. However, the company denied this, and only a contingent liability was provided for in the draft financial statements on 31st December 2008. So State Limited was being sued for anti-competitive behavior. Okay, the company denied this and recorded a contingent liability in the draft financial statements for the year ended December 2008. So in December 2008 financials, which we are preparing for this company has provided a contingent liability against this suit filed by somebody against the company. On 14th January 2009, the court awarded 70 million damages against Sham Limited. The date for the approval of the financial statements by the management for issue to the supervisory board, that is board of directors, was 9th March. So March 9 is the date of approval of the accounts by the board of directors. Okay, so we are preparing the accounts for December 31st 2008. On 14th January, court has awarded 17 million damages and board has approved the financial statements on 9th of March 2009. So this event is occurring between the end of the reporting period and the date of approval of the accounts by the board of directors. Hence, it is meeting the definition of event occurring after the reporting period as per Ind AS 10. Now we only need to classify this event, whether this event is an adjusting event or this event is a non-adjusting event. But for sure, this event is an event occurring after reporting period and covered by the scope of this Ind AS. The date for the approval. Okay, determine whether the event has occurred before or after the reporting period and give the accounting entries along with disclosures. So first of all, question is asking you to determine whether this event is adjusting event or whether this event is a non-adjusting event. And if you say it is an adjusting event, what are the accounting entries you will pass? If you say it is a non-adjusting event, what are the disclosures you will make? Okay, so first of all, tell me whether this event is an adjusting event or not. So Throw me answer, adjusting, non-adjusting, what you believe. Okay, let's discuss the solution. This is an event occurring after the reporting date, but before the approval of the financial statements for issue. That is, event is happening in between the two dates. This event affects the valuation of the company's liabilities. Hence, it is an adjusting event. State Limited must create a provision of rupees 70 million in the financial statements for 2008 instead of a contingent liability. So State Limited for the time being has provided only a contingent liability, but since this event is a adjusting event because case was already filed before the year end and has been decided subsequently, so evidences and conditions were existing at the reporting date. So State Limited should have made a best management estimate to provide for the liability which is expected to arise if they lose the case. So 70 million is to be provided for since the case has been decided prior to the approval of accounts by the board of directors. Hence 70 million will be recorded as a provision instead of a contingent liability. So accounting entry will be passed debit, legal costs, credit, provision account. So expense name is the legal cost because the question was talking about the anti-competitive behavior. Okay, so 70 million is the amount of provision which will be creating. Now what will be the disclosure for this? The company had a contingent liability of rupees 70 million as of December 8 relating to the court case by the competitors on January 2009. The court order was passed, the liability 17 million become payable. So since the liability has become payable, therefore the company must change the contingent liability into a provision of rupees 70 million in its financial statements. So we will make a disclosure that earlier we were reporting the contingent liability, but now the case has been decided against us. Hence we have provided for this case by the amount of 70 million, which is expected to be paid by us to the third party. Okay, this is the disclosure which we will be making. Very simple question it was. So a few of the responses I have received from people Lucknow, Delhi and DLR that this event is an adjusting event. So all the answers are correct on this question. Now let's move to question number 4. The statutory audit of ABC Limited for the year ended June 30, 2013 was completed on August 30, 2013. Okay. So statutory audit of ABC Limited for the year ended June 30, 2013 was completed on August 30, 2013. So now in this question, please pay attention that our year ending is on June 30. Okay, so June 30, 1st July to June 30 is our year end. And statutory audit is completed on August 30. The financial statements were signed by the managing director on September 8, 2013 and approved by the shareholders on 10th of October 2013. The following 3 post-reporting period events have occurred. So managing director approved the financials on September 8. So this is the approval of the financial statements by the managing director. Okay. And shareholders have approved on October 10, 2013. Okay. So June 30 is my year end date. Auditors have completed their audit on August 30. Financials then were signed by the managing director, that is approved by the board on September 8, and AGM has held on October 10 where the shareholders have approved these financial statements. So these are the events of this question. The following 3 post-reporting periods events have occurred on July 15. On July 15, that is lying between this date and this date. A customer owing rupees 9 lakh to ABC filed for bankruptcy. So customer has become bankrupt on July 15, which is after the closure of my financial statement reporting date, that is June 30. The financial statements include an allowance for doubtful debts pertaining to this customer for only rupees 50,000. So debtor is for 9 lakhs. 50,000 is the provision for bad and doubtful debts, which I have already provided in my books of accounts. And now I come to know that customer has filed for bankruptcy. So this is the one situation. Situation number 2, ABC Limited issued capital comprised rupees 1 lakh equity shares. The company announced a bonus issue of 25,000 shares on August 1, 2013. So August is again between these two dates, June 30 and September 8, when the financial statements are approved by the MD and the board of directors. So all these events, both these events are occurring between these two dates. Hence, these are the events occurring after the reporting period and are well within the scope of this Ind AS 10. Now, only thing we need to decide is whether these events are adjusting events or these events are non-adjusting events. That only is the task on us now. Required. How should ABC Limited account for these two post-reporting events? Provide the reasons for the conclusions. So if you believe that these are adjusting, then tell what is the accounting entry you will be posting. Or if you believe that this is a non-adjusting, then tell why it is a non-adjusting and basically the reason and the conclusion. So tell me, what are your thoughts on this question? I have read the facts for this question for you. Okay. So Neeta Bhojwani has responded from Mumbai that adjusting event. It is an adjusting event. Number one, first event is an adjusting event. Extra provision should be accounted for. Okay. And second, bonus issue is always a non-adjusting event. That's what she has written as a reply to this question. Any other view? Mr. John from Kerala responded, first event is an adjusting event. What about second, John? Somebody has asked whether you have shared this Word document with us. Yes, I have shared already PDF with you, but somehow PDF was not visible on while I was sharing the screen. So I have opened the Word doc. So Word doc and the PDF doc shared with you are same. Ranjit Kumar Mishra asks, sir, please let me know if my chat box is working. Yes, your chat box is working. Please reply, answer to this question. Fast. This is very small question. Maximum 2, 3, 4 minutes you should take to solve this question. Aniruddha from Dholpur responded, first event is adjusting event and second event is non-adjusting event. Okay. So everybody is saying first event is adjusting, second event is non-adjusting. Please let me know if anybody of you has a contrary view to this. Shakti from Chennai responded non-adjusting event for second. What about first? Nagasai responded from Amlapuram, bonus is always a non-adjusting event. Okay. Any contrary view, students? Anybody believes that first event is non-adjusting, second event is adjusting? Okay, let's discuss with the solution. ABC Limited should increase its allowance for doubtful debts to rupees 9 lakh. Now the question has not given anything. The question simply said the balance of the debtor was 9 lakh, 50,000 was provision already provided. Now subsequent to the balance sheet date, debtor has filed for bankruptcy. So this is an adjusting event because debtor's credit worthiness was already impaired by the end of the year. Okay, so this is an adjusting event. Now, since the question is not telling anything whether anything is still receivable from the debtor, hence we assume that nothing is receivable from the debtor. Hence, 9 lakh would be provided for. So 50,000 is already provided for. So additional provision on bad and doubtful debts for rupees 8,50,000 will be provided for. So first event is an adjusting event with an entry of 8,50,000 for the provision for bad and doubtful debts. Srinath from Mumbai responded first adjusting, second non-adjusting. Fair enough. So everybody has responded with the correct answer with no single answer, no single wrong answer. So I hope everybody has understood the concept of adjusting and non-adjusting events. Now next event is Ind AS 33 earning per share requires disclosure transaction as stock splits or right issues which are of significant importance after the reporting period. This is a non-adjusting event and only disclosure is needed. So although Ind AS 10 says that whenever we issue any share capital, be it a fresh share issues, be it a right issue or be it a bonus issue post the year end, it is always treated as a non-adjusting event. However, on the top of it, Ind AS 33 earning per share also requires a disclosure of the transaction as stock splits right issues which are of the significant importance after the reporting period, and this is a non-adjusting event. Only disclosure is required. So there will be two disclosures, one in accordance with Ind AS 10, one in accordance with Ind AS 33 for this particular event of bonus issue. Okay, let's move to question number 5. Management of entity A prepares financial statement as at 31st March 2013. So this is our end of the reporting period date. So for this period we are preparing the financial. So 12 months is the operating cycle. So 1st January to 31st December is our financial year 2013. Okay. The normal operating cycle is 12 months. It has to consider the following. Okay, somebody has asked a query to the prior question. How we come to know that debtor was credit impaired by the end of the date? So if nothing is mentioned in the question about debtor insolvency, that he was credit impaired or not by the end of the date, and question fact simply says that debtor has become insolvent subsequent to the reporting date, then it is always presumed that debtor condition was not well or credit worthiness was not well at the reporting period, because no one in a very short span of time can become insolvent. So it is a process which takes place in some reasonable length of time. So it is assumed that debtor financial condition was not good, hence it has become insolvent subsequent to the date. So if the facts are not complete in the questions in the examination, for the bankruptcy case you always assume that evidences were there for the debtor, unless contrary facts are given in the question that debtor was sound, debtor was good at the balance sheet date but suddenly become insolvent, then don't assume that. Okay, let's move through this question again. Management of entity A prepares financial statements as at 31st December 2013. The normal operating cycle is 12 months. It has to consider the following: 1 to 5 events after the reporting period. Advise the management on recognition and measurement of the below events under Ind AS 10. So there are 5 situations which we now need to deal with and come up with our answer that whether these events are adjusting events or non-adjusting events. Okay, so situation number 1 is entity A. Okay, we are preparing the accounts of entity A. Entity A was sued during 2013. So we are preparing accounts for 31st December 2013, and during the 2013 only this case has been filed against the entity by somebody, some third party. So hence case was already there as at 31st December 2013. Okay, on 31st December 2013 it was not clear of the outcome of the original trial. So as at the end of the reporting period, it is not clear to the management that what will be the outcome of this case, whether it will be favorable or it will be unfavorable. However, entity shortly after 31st December 2013 is convicted. It holds a receivable at amortized cost. Shortly after the reporting period, a debtor files for bankruptcy. So, just a minute. It holds a receivable at amortized cost. So, amortized cost, please ignore. You just read it as it holds a receivable. Receivable means debtor. Shortly after the reporting period, debtor files for bankruptcy. So, this is the situation. Okay. So, during 2013 case has been filed and there was a receivable which has become debtor files for bankruptcy. In 2013 the entity carried out a construction contract. At the end of December 2013, contract cost of 24 have been incurred. Based on the stage of completion, according to the cost to cost method, the total contract revenue was CU60 during the end of January 2014. Due to the increase in prices at commodity exchanges, the estimate of the total contract cost was revised from CU40. So this is another scenario. So we have three scenarios. Number 1, a case. Number 2, a debtor. Number 3, a contract cost. So first of all, let's discuss the case. So outcome is not clear. So if the outcome is not clear, then evidences are there because case was already there. So if case was already there, then outcome is not clear, then we should make a provision for the best estimate. So if the management believes that there are chances of losing the case or more likely than not chances, then as per Ind AS 37, I will make a provision for this. If the management believes that there are more likely than not chances, that more than 50% chances that I will win the case, then I will not make a provision, but I will make a disclosure of contingent liability still. Okay, so because it is not yet certain, so something is uncertain, then contingent liability has to be disclosed. So for first fact is clear. So they are convicted. So entity is convicted means now they need to provide for. So if the entity is convicted after the year end, so it means the court case has been decided against the company. So they have to now provide for the provision. And if the entity is not convicted or no outcome is in place till the approval of the accounts, then a contingent liability has to be disclosed. Now, receivable. A debtor was there which has become insolvent or filed for bankruptcy. So it means it is an adjusting event because we will assume that debtor's credit worthiness was not good at the end of the reporting period. It's just that he has become bankrupt few days after the reporting period. Hence, it is assumed his credit worthiness was already impaired at the end of the reporting period. So again, this is an adjusting event. So first one is an adjusting event, second is an adjusting event. Now, what is the third situation? In 2013, the entity carried out the construction contract. So there is a construction contract which the entity was carrying out in the year. At the end, that is 31st December 2013, contract cost was estimated to be 24 have been incurred. So 24 rupees cost has been incurred on this contract. Based on the stage of completion cost to cost method, the total contract revenue was rupees 60. During the end of the January 2014, due to increase in prices of the commodity exchanges. Commodity exchanges. Please pay attention to the word commodity exchanges. The estimate of the total contract cost was raised from 40 to 60. So earlier cost was estimated 40, out of which 24 has already been incurred. Now, because of change in fluctuation in the raw material prices which we are using to fulfill this contract, this cost has run up to 48, that is increased. Now, what do you think? Is this event an adjusting event or non-adjusting event? So, commodity exchange prices have changed in the month of January, not as at 31st December, for which period we are preparing the accounts. So, do we need to adjust this or not? So, please respond yes or no, or adjusting or non-adjusting for the fact pattern 3. 3, adjusting because we should provide for all possible losses. Okay. 1, adjusting. 2, adjusting. So 1 and 2 we have already discussed are adjusting. What is the answer for 3? I'm just waiting for 10 seconds so that if anybody responds, so that it becomes clear to me whether you are on the same page or not, or are you able to understand the facts. So nobody has come up with this answer. For the third, only one person has responded that this is an adjusting event. He has also responded event 4 adjusting event, event 5 non-adjusting event. Okay, very quick. Vikas Gupta from Kathmandu. Okay, so let's see the answer number 3. The question is whether stage of completion is 60% 24 to 40 or 50% 24 to 48. As this is a non-adjusting event, the stage of completion is 60%. The revenue is Q30. So Cu60 into my currency unit 60 into my 60%. So this is a non-adjusting event because we never account for fluctuation in the prices of any of the commodities which are being traded on the stock exchanges. So I have told you that please pay attention to the word commodity exchange. So the costs which we account for are in line with our cost estimate and basis on the percentage completion stages. But if the fluctuation is happening because these raw material is traded like copper is being traded on the MCX or NCDEX on a daily basis. So I don't pick up the price of the subsequent period for revaluing my inventory or cost of construction contract. So I have already highlighted this earlier in my discussion that share market prices, commodity exchange prices, we do not account for as a adjusting event. These are always non-adjusting events. Please remember it as a thumb rule. Now event number 4. During the first week of January 2014, the part of the production facility and inventory is destroyed in the heavy rainstorm, but business activities are continued. The damages are not covered by the insurance. What we need to do in this case, event number 4. So in the first week of January, there was heavy rain and business is discontinued, but damages are not covered by the insurance. So insurance probably management has taken, but the damages clause is not there. So insurance company is not going to pay for any of the damages to the production facility which has been destroyed by the heavy rainstorm which has occurred in the month of January. That is after the end of the year end of December 2004. So fourth is adjusting or non-adjusting. Fourth is non-adjusting. Why? Because rain has happened after the year end of 31st December 2013. Therefore, the amounts recognized in the entity's financial statements as at December 13 are not adjusted for this event. However, the entity shall disclose the event and estimate its financial effect on the statement that such an estimate cannot be made. So, entity will only make a disclosure about this non-adjusting event. Because rain has occurred after the balance sheet date and there was no indicators that because of the rain something is structurally fault, as we studied in our previous example. So there were no such facts. So rains are always non-adjusting events otherwise. And fact pattern 5. Entity has some investment in a listed company and its carrying value was currency unit 70, so rupees 70 as at December 2013, and the second week of January 2014 the stock market suffered a serious and unexpected crash and the share price dropped significantly to the extent that the carrying value was CU20. So please let me know, is this an adjusting event or non-adjusting event? So I am carrying an investment of a listed company. I have taken an example of Reliance Industries that because of share market fall after the reporting period, after the year end, my share investments value have fallen significantly. Do I need to account for it? Yes or no? Are these events adjusting or non-adjusting? Share market fall event is adjusting event or non-adjusting event? So these are non-adjusting events. The stock market crash was not in existence or could have been foreseen on December 30, 2013 and therefore this would be a non-adjusting event under India's 10 para 11. Okay, para 11 of India's 10 clearly talks about this. As a result, the management should not amend the carrying value of the investment as at the December CU70 but make a disclosure. So we always make a disclosure about the non-adjusting events. So we will simply make a line, write a line in our notes to accounts that because of a significant fall in the share market, the investment's value have eroded by this much amount. But that's it. That's the disclosure which we will be making. Disclosures are always required whenever there are non-adjusting events, and for adjusting events as well we make a disclosure. So disclosure piece is required for both adjusting and non-adjusting. Adjusting requires accounting and disclosure both. Non-adjusting requires only disclosures. So Nita is asking when we make disclosures. So we make disclosures always whenever it is required by the India. So India's 10 is specifically demanding for the disclosures for all the non-adjusting events. So we will make the disclosures, and for adjusting events is as well, if it is asking that please explain the nature of the event, we will be making those disclosures. So disclosures piece we will be discussing after coming back to the slides. So I hope I have covered a lot of facts and scenarios, and these material have already been shared with you for your future reference. All the solutions are given, all the RTP and exam questions are covered by me pertaining to this index. Let's move back to our slide. So I hope the slide is now visible to everybody. I'm just maximizing it. I hope the slide is visible to everybody. Can somebody tell me in the comment box?
Yes.
Okay. Now, last concept of the standard. So at the start of the standard, I have explained that this standard is talking about three things. Number 1, adjusting events. Number 2, non-adjusting events. And number 3, going concern. So adjusting we understood. Non-adjusting we understood. We have done practical questions as well on those concepts and numerous examples of all the scenarios. Now we will discuss the going concern. Now what the standard says? A standard says an entity shall not prepare its financial statements on a going concern basis if management determines after the reporting period either that it intends to liquidate the entity or to cease the trading. or that it has no realistic alternative but to do so. So as I mentioned at the start of the lecture is we prepare our financial statements on a fundamental assumption of going concern. Okay. Now this standard is saying if management believes that their going concern, fundamental assumption of going concern has taken a hit, or they believe that they are not able to continue the business for the next 12 months from the reporting date, end of the reporting date, then they should not prepare the financial statements on going concern basis. The standard is not saying what is going concern when it will be hit. Standard is saying when it is hit, you should not prepare the financial statements on going concern basis. Okay. Going concern is defined under Ind AS 1. Ind AS 1 you have already studied. So what is going concern? Going concern is defined under Ind AS 1. Now, an entity shall not prepare its financial statements on a going concern basis if management determines whether after the reporting period either that it intends to liquidate the entity or cease the trading or cease the operations of the company and has no realistic alternative but to do so. So management has left with no alternative other than to wind up the business. Then if this is the situation, then management should not prepare the financial statements on going concern basis in accordance with Ind AS 10, because Ind AS 10 prohibits to prepare financial statements on going concern basis if going concern is hit. Now, Ind AS 10 prescribes that deterioration in the operating results and financial position after the reporting period may indicate a need to consider whether the going concern assumption is still appropriate or not. Now let's take an example of COVID-19. So because of COVID-19, if business is severely impacted, then if management believes yes, going concern is hit and we are not able to continue our business for next 12 months or for next operating cycle from the end of the reporting period, then Ind AS 10 prohibits management to prepare the financial statements on the going concern basis. Okay, so if deterioration in the operating results and financial position after the reporting period indicates that they need to consider whether their going concern is appropriate or not, then please consider first whether going concern is appropriate or not. And if it is appropriate, then only you prepare the financial statements on the going concern basis, otherwise not. Okay, let's do this question, which is again from RTP for May 19 going concern. XYZ Limited was formed to secure the tenders floated by a telecom company for publication of telephone directories. It bagged the tender for publishing directories for Pune Circle for 5 years. It has made a profit in 2013, 14, 14, 15, 15, 16 and 16, 17. So simply, question facts are simple that XYZ is a telecom company. They have received an order from Pune Circle for 5 years, and 5 years out of 5 years, 4 years are completed. That is, financial year 13-14 is completed, financial year 14-15 is completed, financial year 15-16 is completed, financial year 16-17 is completed. Okay. Now, it bid in tenders for publication of directories for other cities or for other circles, Nagpur, Nashik, Mumbai, Hyderabad. But as per the tender results declared, so tender results have come out on 23rd of April 23rd of April 2017. That is after the end of the financial year for which we are preparing the financial statements. The company failed to bag any of these orders. So company has applied for more tenders and the result has come out. So company has applied for these tenders prior to 2017. It means during the 2017, but result has come out after the end of the March 17. So in 23rd April 2017. If it's the only activity till date is publication of Pune. So only the company is having old contract, the Pune contract, for which 4 years are already completed and 1 year is only left. The contract for publication of directives for Pune will expire on 31st December 2017. So 31st December 2017 is the expiry date. That is 9 months from March 17 accounts. So lesser than 12 months from March 17 accounts, which we are preparing. So we are preparing March 17 accounts, and the contract, the only contract the company has, is expiring on 31st December. Hence, within 9 months, company's main contract on which the company is dependent for its business is expiring, and company has failed to obtain any other contract as of now. So it means after 9 months, company has nothing to do with its operations. Company's operations are at hold till the time further order gets they get. Okay. Now going concern says if management believes they are not able to continue the operations for next 12 months, then you should not prepare the financial statements on going concern basis. Then basis on these facts, what is your take? Do you advise as a chartered accountant to the management that prepare financial statements on going concern basis, or will you advise that your going concern is not appropriate, hence you shouldn't prepare the financial statements on going concern basis? So Ranjit Mishra from New Delhi responded, not on going concern basis. Okay. Anybody else, or anybody has a contrary view who wants to prepare the financial statements in this case on a going concern basis? So I think question is already discussed at length. So now let's see quickly the answer. And entity para 14 of India says an entity shall not prepare financial statements on a going concern basis if management determines after the reporting period either that it intends to liquidate the entity or to cease the trading or has no other realistic alternative but to do so. Okay. Para 15 says deterioration in operating results and financial position after the reporting period may indicate a need to consider whether the going concern assumption is still appropriate. Now deterioration is happening or not in operations? Yes, because I have only 9 months contract in hand. I do not have any other contracts in hand. All the contracts I have applied so far are I haven't received or I haven't obtained. So deterioration is happening in my operations. Okay, operating results. Now it says if deterioration happens, then management need to consider in spite of this deterioration, management believes that going concern is appropriate. If yes, management believes yes, we have also applied for other contracts and I am very hopeful that we will receive those contracts. Then you can go for it and prepare the financial statements on a going concern basis. But if management says no, we do not have any other applications in hand for which results are awaited and all the results have arrived and we have not received any contracts and hence after 9 months we have nothing to do. Hence, going concern is not appropriate. Then in that case, financial statements will not be prepared on the going concern assumption. So this is the descriptive question which was available in your RTP and this is the suggested solution by the institute. So in accordance with the above, an entity needs to change the basis of accounting if the effect of deterioration in the operating results and financial position is so pervasive that management determines after the reporting period either that it intends to liquidate the entity or cease the trading or has no other realistic alternative but to do so. In the instant case, since the contract is expiring on 31st December 17, that is after 9 months from the end of the reporting date, that is within 12 months from the end of the reporting period, and before the approval of the financial statements, management has no further contract is secured, implies that entities' operations are expected to come to an end. Accordingly, if entities' operations are expected to come to an end, the entity needs to make a judgment as to whether it has any realistic possibility to continue or not. In case the entity determines that it has no realistic alternative of continuing the business, preparation of financial statements for 16, 17 and thereafter on going concern basis may not be appropriate. So we will prepare our accounts not on going concern basis. Now, what are the disclosures required by this standard? So first of all, we make a disclosure when the accounts are approved, that is when the board meeting has happened, when the board of directors have approved the accounts for issue. Who has approved? Board of directors. So we will mention that board of directors have approved the financial statements for a company. In case of partnership firms, although indices are not applicable in partnership firms, the partners approves the financial. So approving authority is the partners in partnership firms, board of directors in companies. Okay. and proprietor in case of sole proprietor. Although indices are not applicable on those entities, indices are applicable only for the companies as of now. If the entity's owners or others have the power to amend the FS after issue, then please disclose this fact. So if any of the entities owners have the powers to amend the financial statements after the approval of board of directors, so if there are any supervisory board or any further hierarchy, then please mention that they have the right to make some amendment. Okay. Update the disclosure in its financial statements to reflect new information received after the reporting period. That is, update on contingent liability amounting disclosures. So if there is any contingent liability, we have disclosed in our financial statement because the event was non-adjusting. So we have not taken a provision, but we have disclosed the contingent liability. Then if any new information has come before the approval and this information makes it evident that this contingent liability should be turned into a provision, then we will turn it into a provision. And if this is not the case, then we will continue to disclose the contingent liability in the disclosure. An entity shall disclose the following for each material category of non-adjusting events. So whichever events we have classified as non-adjusting events, for all those non-adjusting events, the nature, what is the nature of the event? So nature is the rain, nature is the share market fall, nature is the MCX commodity exchange crash. So these are the nature of these events which have occurred, earthquake which have occurred. So these are the nature. So we have to explain the nature first. What is the nature of the non-adjusting events? And then estimate of this event on our financial effect, that is financial statements. So although for non-adjusting events we are not making any adjustment, but we will estimate what is the impact on our financial statement, and we will make it a disclosure in the notes of accounts that because of the rains 1 lakh inventory has been damaged. Although I am not making a provision for 1 lakh inventory in my notes of in my books of accounts, because this is treated as a non-adjusting event. So for all the non-adjusting events, you have to specify the nature and the estimate of the amount by which the financial statements would be impacted in the future period, because this is a non-adjusting event for the previous year only, but not for the future period. So in the year in which the event took place is the event for that period and has to be accounted for. So 1 lakh provision has to be accounted for March 21, if not for March 20 because of non-adjusting event. I hope I made it very clear to all of you. Now the last slide for this standard is Appendix A. Although this is not an important thing and generally not asked in the examination, but still, since it is a part of our standard as forming part of Appendix A, let's quickly understand what is this. So this is talking about a different matter, distribution of non-current assets to owners. Okay, distribution of non-cash assets to owners. Sorry, non-cash assets to owners. Now, I have made the 3-pager Appendix A into one slide in the chart form so that you visualize this chart. If you revise this chart 3-4 times, you visualize the picture and you will be able to revise the concept of this appendix quickly beforehand of your examination date. Distributions of the non-cash asset. I am reading in the first box. Distributions of the non-cash assets. Example, PP&E. Businesses as per Ind AS 103, ownership interest in other entity or disposal groups as per Ind AS 105, and choice of receiving either non-cash assets or a cash alternative. So basically, it is talking about whenever a company distributes some assets to its owners. Who are the owners? Shareholders. Shareholders are the owners of the company, and company has decided to distribute the assets of the company to the shareholders or to the owners. Okay, so this is talking about this transaction. Whenever the company decides to distribute non-cash assets means those assets which are not in cash, like investments. For example, the company is having the Reliance Limited shares, 1,000 shares in its balance sheet, and they have 1,000 shareholders, and they distribute one share of the Reliance Industry to the demat account of the shareholders, each shareholder. So this is a distribution of non-cash assets to the owners. So sometimes it happens, although we do not see these transactions regularly or even remotely, but it is practically possible, although nobody does this kind of transactions in real life. But since the concept is there, we should know about this. Now, on the date of appropriate authorization of declaration of the distribution, recognize a liability for dividend payable. Okay, so whenever a company distributes anything to shareholders, what does it mean? It means simply paying out of a dividend. Now dividend can be in cash or can be non-cash. It is nowhere written that dividend has to be in cash. So if the Reliance Industries Limited shares, which was lying as an investment in the company's balance sheet, and it is distributed to the demat account of the individual shareholders, then this transaction will be recorded or accounted for as a dividend only. So this is a payment of dividend in kind, basically, in the layman's language, payment of dividend in kind. And instead of paying cash, the company is paying anything else to the shareholders. Okay. So on the date of appropriate authorization, please make a note on your slides or somewhere on your writing pad that appropriate authorization happens when something is approved by the shareholders in the AGM or EGM. So dividends are distributed only after the approval of shareholders. It cannot be distributed prior to the approval of shareholders. Okay. So appropriate authorization is given by the shareholders only, either in the extraordinary general meeting or in the annual general meeting. And once the authorization has happened in any EGM or AGM, the company will record a liability in the books of account. At what amount? At the fair value of the assets. So suppose if the AGM or EGM has happened on say 31st of August, okay, for March 20 accounts, then on 31st of August, shareholders have approved that okay, pay us the Reliance share, one share each to 1,000 shareholders. Okay, now on 31st August, what is the market price of the Reliance Industries Limited shares on the NSE or BSE? Suppose say 2000. Then at 2000, I will record a liability. 2000 into 1000 is the amount of the liability which will be recorded on 31st of August, on the date of AGM or AGM. Okay. So liability is recorded at the fair value on the date of the approval by the shareholders. So that is the crux of the second box. Now, what else I need to do? At each reporting date and at settlement date, restate dividend payable with changes. So what happens? I do not know if you have any idea about the financial instruments, Ind AS 109 and Ind AS 32. Okay, so those any financial liability gets restated on each reporting date unless and until it gets settled. Okay. So till the time settlement, till the time I discharge this obligation, means till the time I transfer these shares to the demat accounts of the shareholders, individual shareholders, this liability continue to be restated at the latest available share price of the Reliance Industries Limited on each reporting date. For example, I am a listed company. Okay. Now I prepare accounts on each quarter after the year end. So at 31st March 2020, the board meeting has held in say May, AGM has held in August. In August, shareholders have approved. Then in August only, I will record a liability for March 2021 accounts, not for March 20. Okay, March 2021 accounts, I will record this liability on that day's price. Now, for 30th September, since I need to report half yearly accounts and need to report to SEBI, so I will restate this liability of Reliance Limited shares, which I need to transfer to the shareholders demat account at the market price of 30th September itself. So that is the liability needs to be restated. And if it is not yet settled on 30th September and is about to be settled say in January, then again in December 31, when I will be reporting my quarterly accounts, I will be restating this liability again at the fair market value of the closing price of the share on the exchange. I hope this is clear to you. Now upon settlement, what happens? Suppose I made a settlement in the January 2021. Recognize the difference between the carrying amount of the asset and the dividend payable in the P&L. So my liability was stating say at rupees 2100 into 1000, and on the date of settlement, the price has come down say to 2000. So I am actually settling at 2000 only. So 100 is the differential, is the gain to me, because I have to pay 2100 share, but I am now giving only 2000 shares. So 100 will be transferred to my P&L as a gain on settlement. Or if the price has moved up, then loss on settlement. So these gain and loss on settlement I will be accounting for on the date of the settlement itself. Now, what are the presentation and disclosure requirements for these transactions? Present the difference described above as a separate line item in the P&L. So I will present this difference. Which difference? a difference between the fair value of the liability and the settlement date liability value in the P&L separately. So I will not club this item gain or loss on settlement. I need to make it visible to the users of the financial statements that this is the gain or loss on the settlement of this transaction. So this has to be presented on the face of the P&L as a separate line item, not to be clubbed in any other expenses or any other income. Okay. And disclosures, opening and closing carrying amounts of the dividend payable. So I have told you until settlement I will be restating. So I will be making a walk from the day one I recorded the liability, then what is the opening and what is the change to this and what is the closing liability. So this schedule I will make a disclosure in notes to accounts. This appendix does not apply to distribution of a non-cash asset that is ultimately controlled by the same party or parties before and after the distribution. And this appendix is only applicable for the shareholders who are not the controllers of the company. So if a bunch of shareholders who were controlling the company earlier and controlling the company after the distribution, then if the party is the same, then this appendix is not applicable. So this appendix is applicable only for those transactions where the distribution is happening for the shareholders at large. Okay. So this is a simple concept. Basically, just we need to record a liability for dividend payable, be it a non-cash asset or cash asset, which we are going to distribute to the owners or shareholders, and we need to restate it at each reporting date until settlement, and difference needs to be disclosed in the P&L as a separate line item. So this standard is closed from my side. I have tried to cover all the concepts and practical illustrations which were available in the RTP's study material or the examination or any other else, any other place, and hope you found it good and understanding or informative for you. Please let me know
please
if you
do
have any
fill the
specific
feedback
queries.
form, and please do fill the feedback form. That is very important, and we work on your suggestions. In that feedback form, if you have any suggestions, please do fill that also.
So somebody has asked,
Sir, in case
what is the difference between preparing financial statements on going concern basis and not on going concern basis? What would be the difference in the two financial statements? Okay. So India's 10 doesn't prescribe how to prepare financial statements if going concern is hit. India's 10 only says do not prepare financial statements on going concern basis if going concern is hit. Okay, so India's 10 doesn't cover this aspect, but I tell you what is how to deal with this situation. So if going concern is hit, then definitely to comply with India's 10, I will not be preparing my financial statements on going concern basis. Then management needs to decide whether they are liquidating or the liquidator is being appointed. Then they will prepare the financial statements on liquidation basis, and liquidation basis means in the order of the liabilities realization or assets and liabilities realization. So order of assets, how soon I will realize money by selling this asset, and how soon the liability I will be paying. So in the order of their liquidity, I will be stating the position of my assets and liabilities. So this is the liquidation basis which we generally apply if we are not preparing our financial statements on going concern basis. No, bonus issue is not covered in this. Bonus issue is a separate thing. This is talking about distribution of non-current assets. So bonus is not an asset recorded in the balance sheet of the company. Okay. So if something is not an asset in the balance sheet of the company, then it cannot be regarded as a distribution of asset. If I do not have asset, what I am distributing? I'm just distributing nothing. So there has to be some asset in my balance sheet first. Once I have asset, then only I can distribute this asset. So bonus issue is not covered by this appendix. Vijay, I answered your query. Neha from Jodhpur is asking, sir, what if the dividend is in respect of the preference shares? Yes, preference shares. So preference shares first needs to be split accounting. So first of all, we will be calculating the liability component and the equity component in accordance with Ind AS 32 financial instrument and Ind AS 109 by applying the effective interest rate method. And for the equity component, if any dividends are being paid, then those dividends will be accounted for in similar fashion as the dividends are accounted for on equity shares. So there is no difference. Vimal, deemed dividend. Yes, deemed dividend, dividend, proposed dividend, final dividend, interim dividend, all are dividends. All are names or synonyms of the dividends. So all the dividends are dividends. Whether Ind AS 10 EOA, emphasis of what EOA means. Balance sheet date is applicable for annual financial statement only, or is it applicable to interim financial statements? Okay. Yes, this is a good question from Prashant Mehta from Mumbai. Whether Ind AS 10 is applicable only for year-end financial statements, or it is equally applicable on quarter-end financial statements or half-year-end financial statements as well, if the company is a listed company and needs to prepare that. Yes, Ind AS 10 is applicable whenever you prepare the financial statements, whenever, at any reporting date. So Ind AS, if you are preparing financial statements in accordance with Ind AS, okay, then whatever is the reporting period, whatever is the reporting date, Ind AS 10 is applicable. Any restrictions on this distribution as overdue creditors may object? So that is a legal issue. That is not an accounting issue. I am discussing accounting issue. If creditors are objecting for distribution of such non-cash assets to the shareholders, then definitely it cannot be distributed. And if it is not approved or cannot be distributed somehow, then definitely no liability needs to be recorded. So that is a legal issue, how to deal with this situation. But if it is approved by the shareholders and it is distributable, then I will record the liability. No, paragraphs numbers are not mandatory to mention in exams. As I already told, you only mention those things for which you are pretty sure. If you are sure Ind AS number, if you are sure Ind AS name, and if you are pretty sure about the para number, then only please mention, otherwise don't. I think I have answered, since queries are being of repetitive nature. So I think I have answered almost all the queries which has come to me, and we can now wind up the session. So thank you students for listening me patiently today, and I hope the session was good and informative to you. Thank you.
Thank you, sir.